are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different. Returns which are excess what you would get in other places, where there is lack of...
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Looking at potentially 2 days of losses here on the S&P 500, down by 0.2%. Bond yields a little bit higher, up by 3. The standout move, crude once again, up by 3.5%. WTI, 72.26. Under surveillance this morning, half of U.S. trade at a standstill.
First few days, the economy can handle, we think. There should be stocks of inventories that are there at the dock, that are there in retailers' inventories. The bigger issue is, do you have inputs to the production process that you really can't substitute for? It could be a month from now where you can't produce the new cars. And then that's where retailers will have to start to say, we actually have to raise these prices. We have a shortage of goods.
So here's the latest. The strike at all major ports on the U.S. East and Gulf Coast triggering fresh concerns about job losses and supply-driven inflation. Anna Wong of Bloomberg Economics writing, if the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as many as 80,000 jobs, which would boost the odds of a jumbo rate cut at the November FOMC meeting. Anna joins us now for more. Anna, I enjoyed the note published yesterday afternoon. I want to say thank you on behalf of the team because it was a fantastic read. There's a word that jumped out for me. Inventories. How well stocked are we now versus where we were several years ago?
Yeah, so when we looked at wholesale inventories, we can see that cars, for example, which is one of the most affected category by the strikes, has a higher inventory level to sales ratio than most times in the past 20 years, except for 2020 and 2009. So we're not in a situation right now where you have a supply shock in combination with strong demand. Demand is not really there. So we think that the inflationary effect of the strike would be more muted than what we had seen in 2021 and 2022. Anna,
your jobs call hinges on this lasting more than 2 weeks. What's important about 2 weeks? Just a quirk of the calendar? What is it?
It's a quirk about how payrolls are measured. So in order for a person to be not counted in the payrolls, you need to not receive a check in the entirety of the reference week. And the reference week from the payroll goes from October 1st to the day involving the 12th. So basically, you need the strike to last for at least 2 weeks because most people are on a 2 weeks payroll. And then all 45,000 people who are on strike will not receive a check in the first 2 weeks. Then you will start to see these numbers showing up. And on top of that, beyond 2 weeks, you'll have the supply chain effects. So basically, the truck drivers won't get paid. And we also see a lot of impact on food and beverages, people catering to the longshoremen, and also a lot of employment services. retail, wholesale people will start to be affected, and that's how we got the 80,000.
Anna, appreciate the update. Anna Wong of Bloomberg Economics. Anna's quote, if the strike lasts more than 2 weeks, we estimate the knock-on effects could lower October payrolls by as much as 80,000 jobs, going on to say that would boost the odds of a jumbo rate cut at the November Fed meeting. Ryan Sweet of Oxford Economics joins us now for more. Ryan, I'm sure you followed a bit of that conversation. Why wouldn't the Fed just look through all of this and assume that those jobs come back, things bounce back in the months ahead?
Well, I think most likely they would. I mean, the Fed's laser focused on the labor market, and as Anna pointed out, the port strike isn't the only noise that we're most likely going to get in the October jobs number. We have a Boeing strike. We have Hurricane Helene. So the October employment data is going to look very, very messy, and odds are the Fed kind of downplays that and kind of tries to separate the signal from the noise. And it's just going to be too noisy for the Fed to make any concrete assessment of the labor market based on just a single report.
Ryan, one thing that people have been talking about is that the effects of this kind of strike aren't that significant in the first week, maybe even the first 2 weeks, but the longer it goes on, it has an exponentially higher impact on GDP and on just jobs in general. What is that trigger point? What is that sort of time frame that you start to see the ramifications becoming exponentially more significant?
Yeah, I'll start to get really worried if this drags into week 3, week 4, because even though we do have a boatload of inventories, retailers did some preemptive inventory build ahead of the port strike. A lot of the perishable goods that are imported through the ports in the Northeast and the Gulf Coast, they can get shipped in via truck through Latin America and Central America. But if this lasts 3-4 weeks, then the economic costs, as you pointed out, kind of escalate very, very quickly. So as of right now, each passing week shaves about 1 percentage point, a tenth of a percentage point, off of Q4 GDP. But if this drags on, the economic costs just begin to escalate very, very quickly.
You talk about $4.5 billion to $7.5 billion of U.S. GDP being reduced for every week that this continues. You also pointed out that it would take about a month for every week to recover some of the backlog. A key question about why now? Why the leverage right now seems to be more with the workers to do this? Is it political? Is it because workers generally have more leverage in their jobs? Or is that era on the wane and this is sort of the last gasp of that?
Well, this isn't the first strike that we've seen over the last several years. And then I don't think this is the last gasp. But, I'm not sure if this is political, if this is just, timing of when the contract was, negotiations started running out. But from our perspective, just looking at the economics, the nuts and the bolts, that's key for us. And this is poor timing. This is, it's not the worst timing in the world. A few years ago, there was sorts of other strikes that would have really undermined the economy. The U.S. economy is in, pretty good shape. Trend GDP growth is 2.5–3%. The unemployment rate has ticked up, but, we're still creating a number of jobs. The timing is never great for a strike like this, but hopefully this lasts just a week or two, and it's a little bit of another blip on the economy's radar.
Ryan, given the fact that shipments are now being redirected to the West Coast, what kind of crunch and backlog are we going to see on the West Coast?
A lot. I mean, the capacity, if you look at, for example, when the bridge collapsed near the port of Baltimore, some of that trade could get rerouted to the port of Philadelphia, up to New York. With a strike of this magnitude on the East Coast and the Gulf Coast, those shipping routes, they can't get rerouted to the West Coast, all of it, because there's just capacity constraints. So this is going to cause, a significant backlog, but, we can work through this. I mean, it's going to take time. When the strike ends, it's not like we're going to be able to work through all the container backlog in a couple of days. This is going to take potentially weeks and even a month or two. But the good news is, the impact on the labor market, the impact on GDP, most likely is going to be temporary. We don't see any inflationary implications from this unless this does drag on for a month, 2 months. But we should be able to avoid any reflationary surge.
Ryan, I've got 10 seconds left on the clock. What's your jobs number for Friday?
165. But the key number to watch for the unemployment rate. That's what the Fed's looking at, and that's most likely going to tick up to 4.3%.
Interesting. Ryan Sweet of Oxford Economics. Ryan, appreciate it. I won't ask you what next month's job number is going to be because that's going to be very messy. 150, the estimate for Friday.
And really, to me, one of the questions is how much are we looking at a market that's more poised for a downside surprise than an upside surprise? In other words, which is the more disruptive type of number, 160 or 130? Ostensibly, it's not going to make a difference if you get to 4.3% on the unemployment rate, but really that's the kind of difference that I'm looking for.
Equity futures right now in the S&P 500 slightly softer. We're down 0.1%. A big morning for jobs data. The ADP report at 8:15. Tomorrow morning, jobless claims at 8:30 Eastern time. Then on to Friday. The median estimate in our survey, about 150 for payrolls Friday. In the next hour on Bloomberg Surveillance, here's the lineup for you. Whaley of BlackRock, Javier Blas of Bloomberg Opinion, and we'll be catching up with the CEO of Apollo, Mark Rowan, at Apollo HQ. That stock yesterday closing at all-time highs on Investor Day with a very punchy target, projecting $10 billion of annual earnings in 5 years. We'll get into that and what to do with your money. That's in the next hour of Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Growth may not
be strong enough to keep the unemployment rate from rising. So that's another reason for the Fed to be easing.
With the Fed really wanting to be patient and not overreact, I think that they'll likely go from a 25 basis point cut from here on out.
This is the stuff they're trying to figure out to get us to have that soft landing.
You're very unlikely to see a recession materializing over the next 18 months.
In terms of our own economy, I actually think it's going to be fine.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Was I too bullish? Was that what happened? I'm not Jonathan Farrow. He left to go have that interview.
Out of the studio.
Yeah, stormed out of the studio to go to Apollo to interview Mark Rowan. We will continue this morning. Looking forward to that interview in about a half an hour time from New York City. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern here. I'm Lisa Abramowitz on second day of losses, really a turmoil here as people parse through a whole host of potential downside risks to the economy, not least of which is the fact that it's October and tends to be a tumultuous week, but really very much front and focus. We're looking at the Russell 2000 underperforming the most, down by 0.6% on the heels of a couple of data points yesterday that raised some questions, Anne-Marie, about just how resilient, just how much momentum there is underpinning the U.S. labor market.
Right, and the quits rate, which you brought up earlier, fell to the lowest level since the pandemic, which is why I think it's so interesting today. We are going to get ADP, and more people in the market are actually leaning into ADP because they just don't trust what's coming out, the data that's coming out of the Labor Department. So we also, of course, will have jobs this week. That's going to be really important. But I almost want to look through this jobs report because the next one will be so much more interesting. Boeing, the hurricane, and the dock workers. What kind of impact will that have? And will that mean a recalibration potentially at the Fed?
This is the reason why people are sort of wondering how much credence to put into these different things. Watch this space in 75 minutes. We're going to be getting that ADP report, which people are putting a greater emphasis on. We are seeing in the oil space a rally, second day of a pretty significant rally on the heels of some of what we're seeing in the Middle East. Iran launched a direct ballistic missile attack on Israel, about almost 200 missiles coming over. They were mostly shot down, but a real question about what kind of response there will be, given the fact that Israel pledges to retaliate. I just wonder at this point, Anne-Marie, how much people have gotten used to, benumbed, if you will, to this idea that any kind of escalation in conflict isn't going to have massive ramifications on the oil space.
That's because of two things. One, we haven't actually seen supply that's actually getting hit. And then if you're concerned about supply, we'll just look no further than Riyadh or Abu Dhabi, where they have spare capacity. Then on the demand side, China is not picking up. Goldman Sachs, HSBC, they're still talking about the fact that they're not seeing that demand from China. So that's putting a lid on the actual prices. But that 5% we saw yesterday, that knee-jerk reaction when Iran, for the second time this year, sent over ballistic missiles to Israel, 5%, the market is still carrying that through. So there's a little bit more risk premium actually baked in when it comes to geopolitical risk.
So what strikes me right now is you've got the jobs data that's coming through. We're going to get ADP at 8:15 a.m. Eastern ahead of that jobs report on Friday. We have what's going on in the Middle East, the geopolitical tensions that are percolating up. And then you have this, which is the stimulus, the bazooka. It's increasingly looking like a bazooka from China that a lot of people are saying is truly a game changer. People thought that there would be some kind of response, but this was such a marked response that suddenly people are rethinking just how much they can avoid going into China. Chinese stocks listed on the Hong Kong index came in with a 7% gain after the holiday, and really highlights just how much the tone has shifted. You just wonder how much of a knock-on this effect this will have in the broader market.
I still have a question, though, whether or not people are travelers or settlers when it comes to the Chinese market. Because, yes, this is a bazooka, this is stimulus immediately to the equity markets, but also only in China. What about all those companies that are exposed to China, like in Europe? They're not doing well because they see the national buying in China. And then secondly, long term, is this actually going to address the fundamental issues on the Chinese economy? I still can't get over the fact that in August they had one of the highest youth unemployment rates. Who is buying these products if people don't have jobs?
Well, does that matter if everyone's feeling really good right now? We're going to have that conversation coming up. Wei Li joining us of BlackRock, turning overweight on China following what some people are calling a bazooka. Bloomberg's Javier Blas' strikes on Israel send crude soaring. And our own Jonathan Farrow noted he did not storm out of here angry at us. He is sitting down with Apollo CEO Mark Rowan. We cannot wait to hear that conversation. We begin this hour with traders looking for opportunity thanks to the added stimulus out of China. Stocks surging in Hong Kong, as we were just talking about, with optimism growing for the world's second largest economy. Wei Li of BlackRock saying this: We see room to turn modestly overweight Chinese stocks in the near term, given their near-record discount to developed market shares. We stay nimble and could change our view if the stimulus details disappoint. Wei Li joins us now. Wei Li, Anne-Marie was just asking, and it's a good question. Are you a tourist or are you settling down in some of these Chinese assets?
For now, I would say I'm a tourist. To your point about is it a game changer? I don't know if it is a game changer, but it's creating near-term momentum. So just to contextualize our China view change, our longer-term cautious view hasn't changed, but we're looking at the very attractive valuation, which is around 50% discount, which is close to a record versus the DM equity counterpart, and extremely, extremely light positioning. You look at global active equity allocation to China, it's at close to 10-year low at this point. Of course, cheap valuation is never enough to turn around a market, but when you have valuation and catalyst, which is taking place in the form of stimulus hopes, you see this incredible momentum, which is what we're leaning into. But longer-term challenges very much stay and remain. We're talking about aging population. We're talking about the need for reform. Just for how long can you keep issue government debt, lower rates? That's a template that could work over the near term, but you do need reform to be more persistent.
Are you surprised that Europe isn't also moving higher? Some of these companies that are deeply exposed to China are not moving higher on this stimulus package?
I think that is a great observation, and I think that very much speaks to the fact that this is a near-term momentum story, because if there is huge amount of confidence that this is really going to kind of fix the Chinese economy, then the beneficiaries, secondary beneficiaries of that would actually react. But European equities are not reacting, which shows that it's right now a momentum-leaning story, which is what is underpinning our tactical upgrade.
There's a fascinating kind of implication underneath this, which is you're looking for places to take advantage of risk and momentum to the upside. And it raises this question, especially given how much sort of fear there has been in markets throughout the bulk of this year and how much concern there is about the labor market falling off a cliff. Are you just structurally in a risk-on mode, looking for those opportunities to chase, you know, whether it's the stimulus coming out of certain governments or whether it's rate cuts, is it monetary, or whether it's fiscal stimulus?
Well, I think I should always say no to, am I always structurally risk on? Because there are always issues that we should be worried about. But to your point, at this current juncture, yes, we are. And that is despite the fact that seasonality is not supportive of more risk on posturing, right? We're talking about both this time of the year and also this point in the election cycle. So seasonalities aside, we do see overall environment still supportive of taking risk. We're talking about growth still okay in the US. Q3 GDP now cast is tracking close to 3% on an annualized basis. You talked about labor markets. Labor market is doing fine. It's tracking at a pace that is above pre-pandemic levels, and some of the concern around rise in unemployment rate has to do with the positive supply shock through immigration, which is very, very different from companies laying off people. And then you have the Fed starting to cut and cutting quite quickly as well. We do disagree with market pricing that takes policy rates to below 3% by the end of next year. So we agree with they got to cut. They are cutting right now, but maybe they wouldn't cut as much as before. But the fact that they are cutting is supportive of the risk sentiment, which is what we're leaning into as well. But we're no longer as concentrated in the tech story as we were for most part of last year and this year. We broadened out to the overall U.S. equity market because we see kind of the AI story broadening out, and more broadly, when markets get too worried about recession fear, leaning against that requires a broad-based implementation strategy.
Your colleague Larry Fink was talking about how he thinks that maybe too much has been priced in when he was speaking with Francine Leclerc. Okay, well, good. I'm glad to hear that. I'll let him know. I'm sure he's watching. Larry, she agrees with you. There is a question about how offsides this market would be if we get an upside surprise to non-farm payrolls. In other words, what would be the biggest node of volatility right now? A downside surprise to the labor market or an upside surprise?
I think that has to do with if markets are focused on the growth story or if markets are focused on the inflation story. You look at current inflation trend in Europe is surprising to the downside. In US is falling quite nicely. That's another reason why central banks can cut and also why sentiment is quite positive. But so the focus is very much around growth. And if against that backdrop, non-farm payroll were to surprise to the upside, alleviating some of the recession fears, which we anyway would lean against that could actually be supportive of markets. But it's the market narrative has been shifting so frequently this year. It's really hard to say, even at this point, where is it, Wednesday and non-farm payroll Friday? But who knows, right? There's a lot going on right now. There's a lot going on right now. There is election, geopolitical flare-up in the Middle East, and U.S. data releases. So this focus shifting from inflation to growth, that can shift right back, especially if you look at how energy is responding to the Middle East flare-up. That is actually making interestingly Treasury not as good a diversifier in this environment, which is what we saw yesterday and today.
But wait, hasn't Jay Powell told us that they only really care about the labor market right now?
They of course care about inflation too. They have two mandates. They can say what they want to say, but at the end of the day, they are able to say that because inflation has been well behaving. Now, what's been driving inflation down coming out of the pandemic? That is because inflation was coming down when pandemic distortion was unwinding. And there is more room for that to play out, and growth incrementally slowing down can also kind of take inflation lower, and the labor market immigration story could also take inflation lower. But structurally, inflation is set to settle at a level that's higher than pre-pandemic levels because of supply shocks coming from geopolitical fragmentation, coming from low carbon transition, coming from over time aging population. So when you have all of that together, it's impossible to say that Jay Powell does not care about inflation.
You just said something that was fascinating. You said that bonds are not as good of a diversifier against some of the risks as they have been in the past. And that yesterday was a good example of that. Can you elaborate? Because we did see oil prices pop, but we also did see a flight to havens, a flight to bonds.
Yeah, no, this is really interesting, and I think that very much speaks to the new regime that we're in right now, which is different from the old regime because we now have supply shocks and structurally inflationary pressure. So you see oil prices spiking, you see break-even reacting a little bit, you see markets getting a little bit more worried about that and what that means for bond yields, and as a result, the traditional safe haven quality was not embraced as much, right? I would also observe that even oil, like right now it's going higher, but you look at April, oil price barely reacted. So one has to ask the question, is it fundamentally different right now? The last observation I would make when we're talking about diversification and what worked, what didn't quite work, gold has been behaving reasonably well if you look at the last 2 years or so during times of geopolitical flare-up and market uncertainty. And I think that actually makes it a important consideration from a portfolio perspective.
Wei Li, thank you so much for being here. Wonderful to see you. Wei Li of BlackRock joining us here on set. Right now, let's get you an update on stories elsewhere this morning. Here is our very own, straight from the ports, Bloomberg Brief's Danny Berger.
Hey, Lisa, thank you so much. The death toll from Hurricane Helene has now topped 150 across 6 states and displaced countless others. The federal government reported 29 shelters that are open. They have more than 1,000 occupants. Biden will visit the region today, making a helicopter trip over the flood-hit city of Asheville. He will also visit a rescue command center in the state, and then he will head to South Carolina. Kamala Harris is also headed to Georgia, which was badly hit by the storm as well. McKinsey is pumping the brakes on remote work. Bloomberg is reporting that the consulting company is considering upping the amount of days it expects staffers across Northern America to spend in the office each week. That stricter stance would also likely apply to employees who are in between projects. McKinsey follows several firms that have sought to limit remote work. The first round of the MLB postseason got underway yesterday with 4 games in the wild card round. In the American League, the Tigers defeated the Astros and the Royals eked out a win against the Orioles. In the National League, the Mets overtook the Brewers and the Padres defeated the Braves. The wild card round is a best-of-3 series, so all of yesterday's winnings teams looking to clinch today and to advance to the division series. Today's action starts with the Tigers and Astros with the first pitch scheduled for 2:30 p.m. Eastern. And that's your brief. Lisa.
Thank you so much, Danny. I just want to point out that when John's not here, football's out, and the fact that the Mets, yes, are advancing is on the docket. Up next, Middle East tensions rippling through oil.
We're looking at a market that has been supremely underestimating the potential for all-out war in the Middle East. War is hotter than ever, and oil just continues to trade on the headline.
That's coming up next. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Halfway through the week with another day of losses. Good morning, welcome back. We are seeing the S&P soggy into the open, led down by the Russell 2000, which is underperforming. S&P futures down about 0.25%. You could see a bit of a lift in the euro after yesterday's punishing session, 110.75, breaking below that 111 level, yet still sort of remaining in that level. And crude very much keeping our focus with up now another 3.5% on crude, $72.26. Traded on the NYMEX on the heels of this. Under surveillance this morning, Middle East tensions rippling through oil.
We're looking at a market that has been supremely underestimating the potential for all-out war in the Middle East. War is hotter than ever, and oil just continues to trade on the headline like it did today, but we are well off the highs. So clearly traders are still taking a look-see that things will quickly resolve. We have to keep in mind we must see a disruption in the flow of oil, which we have yet to see.
Here's the latest. Oil prices rising in the wake of Iran's missile attack on Israel. Traders bracing for further disruptions, with Israel vowing to retaliate. Joining us now, I'm so pleased to say, is Bloomberg's Javier Blas. Javier, I just want to start with what's currently being priced into markets and how much of a disruption it could be if this conflict does escalate.
Well, the simple answer is we don't know what the escalation could be, or whether Israel will hit oil installations as the most catastrophic view on the oil market is, or it will be a more pointed response, perhaps similar to April. I do believe that if Israel consults with his allies, and particularly the United States, or even if he listens to the view of China, will indicate that there are two things that they are out of limits for any retaliation. One, oil infrastructure for exports, and two, desalinization plants, because the fear will be that Israel can hit on the other side of the Gulf, attacking those similar installations, say, on Saudi Arabia, the United Arab Emirates. So we don't know really the impact that this could be. I mean, the market obviously was very short going into the missile strikes, and now there is a significant short covering movement happening, a lot of profit taking from people that went short at $80 and taking profits and securing those profits. So it's a bit too early to say what is going to happen in the next 24 hours.
One thing that I love about your reporting, Javier, is that you're good at understanding the psychology behind certain decisions. And I wonder, when Israel is deciding whether to retaliate and take out certain oil infrastructure in Iran, they don't want to do so because it could disrupt things in some of their allies' economies. On the flip side, Iran isn't going to want to, say, block the Straits of Hormuz because it could also anger allies of its country, like, for example, China. How much is there sort of a stalemate that will ultimately protect oil assets versus put these in the target zone?
I think that the biggest problem is the unintended consequences. The more that the conflict continues, and let's remember that we are almost 1 year into the current phase of the conflict, the bigger the risk of something going wrong, that no one really intended to hit something, but ultimately there was a miscalculation and unintended consequence, and oil gets affected. If things go more or less within the guardrails of the two players, I do believe that they managed to keep oil out of the equation, and therefore oil prices ultimately go lower. But I do admit that the longer that this goes, the risk of unintended consequences increases.
Javier, we see this geopolitical risk premium built back into the price, but you have a column out this morning that said the price is now closer to 50 when it comes to the reference value than 100. Explain.
Well, first of all, simple mathematics. You look at where WTI is trading today, around $72 oil. Well, 72 is closer to 50, that is to 100. That is one point. That you have asked me a year ago, 2 years ago, 10 years ago, had Israel taken the leader of Hezbollah, had made Israel an invasion or at least an incursion in southern Lebanon, had Tehran sent close to 200 ballistic missiles into Israel territory, where the price of oil will be, I would have said WTI is going to be trading at $72. I would have indicated something much larger. And there is a second story here in the oil market. There is the story of the geopolitical risk, but there is a story of the oil and supply and demand balances in 2025 and what OPEC is going to do. At the moment, I don't think that there is a need for more Saudi or OPEC oil into next year. However, OPEC has plans to increase production. There is a lot of cheating, and Saudi Arabia is making verbal threats, not so veiled, they're quite public so far, to the cheaters, countries like Iraq, that you need to rein in production. So the politics of OPEC can outweigh the politics of the Middle East between Israel and Iran. And I do think that there is an unappreciated risk that we go a lot lower in supply and demand fundamentals in 2025.
Javier, last week we have a report from the FT that a few analysts poured some cold water on. Do you think Prince Abdulaziz is preparing to really start owning market share and just ignoring the price of crude?
I don't think that the Saudis want to launch a price war. Because they know the consequences of that will be much lower prices. Prices perhaps that they could derail Vision 2030 in the kingdom. Let's not forget that if Saudi Arabia was to go ahead with something that looks like a price war, let alone a full price war of going to production at capacity, which is about 12.5 million barrels a day compared to 9 million barrels a day of current production, prices will go a lot lower because a lot of traders will see that events through the glass of what we know. And the last price war that we have it in very recent memory, that was in 2020. And let's not forget that it ended not at zero, but it went at a minus 40 WTI. And that's when we started to recover. So I don't think that the Saudis want a price war, but the Saudis are making some threats that they are prepared to take those steps to try to bring countries like Iraq, Kazakhstan, Russia, and also the UAE into complying with the production limits. But then again, very similar with the situation between Israel and Iran, the potential of miscalculation, the potential that something goes wrong, that Iraq calls the bluff of the Saudis, that Iraq doesn't reduce production and then the Saudis feel compelled to retaliate. It increases the longer that this goes. And let's be honest, a lot of OPEC countries have been cheating on their production limits for a very, very long time.
It's called fudging, Javier, not cheating. It's drill baby drill season, though, here in the United States. As you know, it's election season. But I have a question for you about shale break even. The former president continues to say that he will bring oil prices down so low, open up the taps. But what is the break even where he needs to make sure there are still higher prices so that shale companies are profitable?
I think that current prices, everyone is still making money in the oil industry. Certainly not as much money as they were making with prices close to $100, but something around $70 WTI is a price that is very comfortable for everyone. We are not going to have a boom in shale production. Shale production at these levels will slow down. But if I have learned anything over the last 10 years looking at the shale industry is that betting against the ingenuity of American petroleum engineers is a losing proposition. They will get very good at cutting costs, at drill faster, drill better. So yes, things will slow down with shale at $70. Certainly, we will slow down a lot more at 60 or 50, where we may have a contraction even. But shale has rebounded from every price war, from every episode of low prices, stronger, better, leaner, faster.
Javier Blas, thank you so much for being with us. It's always a pleasure to get your insights. Coming up, do not miss this, our very own Jonathan Farrow sitting down with Apollo CEO Mark Rowan to talk about their ambitious profit target, as well as just in general, how their role has changed in this market. From New York, this is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
The middle of the week, and we have possibly a second day of losses. The S&P, the Russell, and the NASDAQ all lower on the day ahead of the open, led down by the Russell 2000. On the heels of both, yes, geopolitical turmoil, but also what we're seeing with respect to jobs. The countdown to the non-farm payrolls really seems to be starting yesterday with that JOLTS report. JOLTS headline number came in okay. If you take a look at the underpinning, though, you see the quits rate coming in at the lowest rate going back to 2020. And Anne-Marie, more questions about just how much resilience there is in a market that's been hot for a very long time.
I know everyone's excited about this week's non-farm payrolls. Market's looking for 150. Do you take the over? Do you take the under? Unless your city's Andrew Hollenhorst is looking for 70,000. But it's the next jobs report that I think is going to be a lot more interesting. How does the Fed look through the fact that we already know it's going to be a soft labor report? If you look into the fact that we have a strike at Boeing, strikes at the docks, and also the effects of Hurricane Helene.
If you bleed it through the bond market, you do see a rally, a bid into bonds that was yesterday carrying through to today on that risk aversion, as well as, although it has flipped around with a little bit of a lift just across the board. Some Somnolent, though, ahead of Friday's report. Two-year yields 3.61%. In the currency market, an interesting story today with Japanese Prime Minister Shigeru Ishiba saying that the economy isn't yet ready for further interest rate hikes, really taking a more dovish tone, similar to what we heard earlier today also from Bank of Japan Governor Ueda. Basically, this question of just how much are they going to normalize? You are seeing a bit of yen weakness, 144.80. In the dollar space, you are seeing a bit of dollar softness across the board. In the euro space, 110.72. Right now, I want to head over to an interview we all are very much looking forward to. Jonathan Farrow just hightailed it out of here to head over to Apollo, sitting down with Mark Rowan, who is the CEO. John, take it away.
Elisa, thank you. This was the deal. We agreed to it. If the stock closed at an all-time high on Invest today, Mark Rowan would show up alongside me, and he's a man of his word. Mark, good morning. It's good to see you.
Thank you. And technically, you're here. You came to visit us, so thank you.
Thank you. You planned it this way, I'm sure. Big target for 2029, $10 billion of annual earnings. I think we have to start with a pretty broad question. Rates are coming down. Economy's pretty decent. Let's just call financial conditions easy. Why are people coming to you instead of just issuing a bond in public markets?
I think if they come to us when they can't issue a bond in public markets. And can't is not that it's not open. It's that they want to do something that the public markets will not allow. Public markets over the past 2 decades have become very vanilla. Call it beta. If you want to do something unique, if you want to finance the next generation of infrastructure, you want to build a project, you want to build data centers, you want to build power, you want long dated, you want special features, that's just not available. You come to someone like us, and increasingly, private markets are offering really compelling solutions to investment-grade borrowers.
Let's talk about some of those deals. AT&T, AB InBev, Intel recently. What's the common theme behind those 3 companies for you?
The common theme for us is excess return relative to the credit of the underlying borrower. The common theme for the issuer is they are achieving something they could not otherwise achieve. When we did AB InBev, some $6 billion years ago, everyone around us, our peer group, that was interesting. That was one-off in COVID. You'll never do another one, another investment-grade private deal. $100 billion later, we're still doing investment-grade private deals. And I see nothing but a long line of interesting borrowers and interesting situations, because think about what we're doing in the world today. We are building infrastructure. We are building and changing energy transition. We're just at the beginning of this. And we are building the next generation of data and power. Every one of those things is long dated. Many of them are complex financings. Some will go to the banking system. Some will go to public markets. But increasingly, For these more complicated financings and long-dated financings, private market investment grade is where borrowers are coming.
There was a theme in Investor Day, and you've talked about this with me yourself privately. Global industrial renaissance. What are you talking about?
We're talking about just this massive need for capital. I mean, you can believe or not believe all the figures that are out there, but when you add up the amount of money that is needed for energy transition, the amount of money that is needed to fix our infrastructure, the amount of money that will be needed to build data centers and power to supply them, much less to connect and redo our power lines, you're talking about the amount of money that's been spent since the invention of all with a backdrop of the U.S. government borrowing $2 trillion to finance itself on a current basis. This is not a question of will private markets grow. The question will be how much. Yes, public markets will continue to play a really important role, banking system, really important role, but this tool, this notion of private investment grade, has really not been available to CFOs or others arranging financing, and increasingly it will be.
How labor intensive is this for you? And as you do more deals, do you get a benefit from that you are able to replicate things and use less and less people to scale up?
The scars of experience.
Yeah.
So these are all labor intensive, and that is actually what the competitive advantage is. The investment grade bond market became so efficient and so low cost that financial firms stopped allocating resources to it. There was just not any money in doing that. And so the market is very available, but it is very plain vanilla. Almost no one has built what we've built. When you look at employment at Apollo, the greatest group of employment, 4,000 people, some $8 billion that we've spent over the past 15 years, all goes to what we call origination. Now, not all of these originators are out calling on investment-grade borrowers. Some are running other types of origination vehicles: aircraft finance, fleet finance, receivables finance, inventory finance, infrastructure finance. Increasingly, this is how America borrows.
Introduce Citi and a $25 billion partnership. What's behind that? Is that an acknowledgement from you that you've got more cash than you know what to do with?
I think it's an acknowledgement that origination, the control of the product, is actually what has value. And some of that origination we're going to build ourselves, and we've built more of it than any, but let's face it, a whole industry is short origination. To the extent we can find a meeting of the minds with Citi, that's fabulous. And I think the bigger theme here is the banking system, particularly one of the big four banks, is actually figuring out what we believe all along. We don't want what the bank wants. We don't want the bank's customer. We want the asset. The bank, we can't offer advice, M&A, derivatives, hedging, foreign exchange, payments, credit cards, or any other service. The bank wants to offer those things. The bank sometimes wants the loan, but more often than not does not want the loan.
Who do you think fielded the most calls that day when that was announced, that partnership? Was it Jane Fraser and annoyed asset managers, or was it you and annoyed bankers?
From the comparing of notes last night, it was Jane.
It was Jane? Did you get the calls yourself from other banks?
We definitely got a few calls.
Do you get the sense that this is the beginning of something bigger? 25 billion is the number with Citi. Just give me an idea of what this looks like further down the line. Does it include other banks too?
I think it does. And now, I think it is difficult to serve lots of people in the same way with the same terms, but the Citi partnership is focused on a certain type of borrower. I think you'll see international partnerships. I think you'll see investment-grade partnerships. I think you'll see infrastructure-related partnerships. I do think that we are becoming a partner in some ways to the banking system rather than how it is portrayed in the press, which is, a fierce competition over everything.
This conversation so far has really been about how the financing of companies, particularly in this country, is changing, how the companies doing the financing is shifting, the emphasis being on private markets. Part of your vision is how investing is going to change as well. So let's spend some time on that. How is investing going to change? How do we think about public versus private now? And how do you hope we're going to think about it in years to come?
Look, for me, this is year 40. It's sometimes hard to believe I've been doing it this long, but we grew up thinking private was risky and public was safe. And probably 40 years ago, that was true. Private was three products: private equity, venture capital, and hedge funds, all three of which can be risky, but done the right way are excellent investments. And public was 8,000 public companies, diversified portfolios of stocks and bonds. Let's just say that's not how the world is today. The world that we see, private is safe and risky, and public is safe and risky. And if that's true, Everything we know about portfolio management, the way we construct portfolios today, is going to change. Think of the typical investor. A very bland, I say a 3-flavor ice cream portfolio.
Sure.
Stocks, bonds, and a little bit of alternatives. Why? Well, because when something is risky, you put it in a small bucket called alternatives. You watch it carefully, and you demand high returns out of it. But if private is just another form, I think what you're going to see is the whole business of what I call replacement. Fixed income, which today means investment-grade public credit, I think is going to be investment-grade public and investment-grade private. 18 months from now, I do not believe investors will actually know the difference between investment-grade public and investment-grade private. It will not be the issuers, it will not be the size, it will not be the ratings, it will not even be the liquidity. Everything that exists in the public markets, repo, borrowing, market making, daily pricing, is coming to the private markets.
What is the total addressable market? What kind of numbers are we thinking about?
We're talking about massive marketplace. When we look at the entirety of our industry, the entirety of our industry has been built out of the alternative bucket of institutional investors. The fixed income bucket, which is the one I'm talking about now, is 50% larger than the alternative bucket and is mostly 100% private, or excuse me, public investment grade.
Equity, different to debt. Can you tell me how that's going to be transformed and whether some of the companies that typically would be going public are going to stay private? Whether we're going to see a big shift in capital markets over the next 5 years or so on that front?
Well, we're seeing it already. So this is a two-pronged answer, which is 8,000 public companies is now 4,000 public companies. Fewer than 100 companies go public every year, and more than 100 companies go private. There do not seem to be compelling reasons for companies to be public, particularly with what's happened on the investing side. So much of our market today is indexed and correlated. Think of passive now 60–70% of the overall marketplace. Active management, which historically has been the buying and selling of stocks, has really been a very, very difficult place to be, has failed to beat the index 90+% of the time for 20 years. I think we're going to see an evolution also take place in equity. It's going to happen more slowly. In fixed income, we are going to see fixed income replacement. Public and private essentially come together. And the reason I know that is we're seeing it every single day. And in fixed income, we have arbiters of credit quality, rating agencies, who tell investors that something public and something private is of the same quality. In equity, we lack those arbiters. But nonetheless, I think investors are beginning to understand when 10 stocks are 35 to 40% of your portfolio, and 4 stocks have determined all your returns for the past 4 years, and 1 stock has basically been 100% of your quarter. I mean, think of what we've done as a country. We've taken the largest pool of savings in the world, 401k, $12 to $13 trillion, from a group of people who need retirement savings more than ever. What do they own? They own daily liquid stock index funds, generally S&P, for 50 years. Why? Well, we have a mistaken belief that public is safe and private is risky. You look at the best retirement system anywhere in the Western world, in Australia, where they've introduced superannuation 40 years ago. Just a fancy way of saying is they gave the equivalent of 401k investors access to private markets. The returns have been nothing short of spectacular. Outcomes for investors can be not a little better, 50 and 60% better.
You know the view here, public is transparent and private is opaque. How do you change that view?
Well, I think it's going to happen in fixed income. I think when you get to daily pricing, when you get to daily liquidity, when you can see a market, but let's not fool ourselves. Markets are different than we think they are. Everything changed in 2008, as it should, as a response to the financial crisis, but we just did not experience as investors those changes because right after we changed the rules, we printed $8 trillion and everything went up and to the right. One of the most interesting things that changed, there is no liquidity in public fixed income. The stats I've seen, it takes 5 days to sell an investment-grade corporate bond. So when you see a quote, is that liquid? Well, we feel good because it's public, it's there, we can see it. I do think we're going to end up not caring in fixed income in the next 18 months as to whether something is public or private. The comfort that people are developing in private markets on the fixed income side, I believe will eventually extend to equity, and we will see equity also adopt private side by side with public. As I sometimes joke, investors will own equity that is private rather than private equity. The difference being the leverage.
You say we, you mean investors. Do regulators see it the same way?
I think they do. I mean, the conversation with regulators is actually a fascinating one because clearly change is scary. But the typical conversation is every dollar of borrowing that moves outside of the banking system to the investment marketplace. And let's face it, there are only two choices for regulators. Money in an economy can come from investors or from banks. There's no third choice. So every dollar that moves actually delevers the banking system and makes it safer. And people recoil in shock, and this is just math. A bank is levered 12 to 14 times. The typical institutional investor is levered 0. The typical mutual fund, levered 0. Typical BDC, levered 1.5 times. Typical retirement services company, levered 8 times. It is deleveraging. The second is disclosure. We think it's not transparent. The typical bank disclosure says loans to customers and loans to companies. You click on our website, you can see every security we own every quarter. Then you talk about maturity transformation. Maturity transformation is really where the economy has suffered and financial markets have suffered. Banks are in business to do maturity transformation. They borrow short in the form of deposits and lend long in the form of loans. That's not a bad thing. That's just how they're set up. In the investment marketplace, generally you're talking about investors who are matched from a maturity point of view. And the final thing that I always sit with regulators, what percentage of assets in the U.S. banking system are investment grade? They don't know. We have a perception that they're all investment grade, but the reality is about 60% of bank assets are investment grade. You look at a balance sheet like ours, and just as an example, we're 90+% investment grade. And so it's change, but it is actually change that is making the system more robust and more diversified. And we, let's make no mistake, we are the envy of the world. We, the U.S., are the envy of the world. In Europe, they are squeezing the banking system through Basel Endgame, but they haven't yet decided to allow investors to fill that gap. And there are questions. Why are we struggling with financial markets? Well, you're squeezing the banking system and you're not allowing investors to fill the gap.
Have you had this conversation with the senator from Massachusetts? Has that conversation ever happened?
It hasn't, but I welcome it. I spend lots of time in DC and elsewhere speaking to regulators because we are in a really dynamic phase. Everything that we think works the way it works has changed. And we're about to experience and are experiencing the changes that were made in 2008 in response to the financial crisis.
Speaking of changes, Washington, D.C. is becoming increasingly interventionist. You compared some of the benefits of doing business in America and doing business in Europe. Doing business in America is arguably not as easy as it used to be, and it may well get harder. What's your view on where we're heading?
You may be right, but it's all relative. This is the single best market to be in at this point in time, bar none.
When we spoke before Christmas, and we talked about the choices on the menu then for the upcoming election, you weren't too impressed. The menu's changed a little bit. What's your view?
Since I'll be under banishment here if I give you a direct view, let me just say, the way I frame this is you are either more scared of 4 years of the status quo or more scared of 4 years of change. You just have to decide what you're more scared of. Me personally, I'm more scared of 4 years of the status quo.
What's wrong with the status quo?
I see a direction where the trend is not our friend. Right now, we are, as you suggest, we are the single best place to do business in the world. We are the luckiest people in the world. Can we screw it up? Yeah, we can. The notion that we are spending $2 trillion in excess of what we take in peacetime with full employment does not bode well for the availability of capital to do what we need to do for the next generation. We're spending the next generation's money currently.
Do you see anyone on the campaign trail that's willing to do anything about that?
On the campaign trail, no.
In reality?
Well, let's hope. All we can hope for is better governance.
I've said repeatedly on Bloomberg surveillance, on Bloomberg TV, on Bloomberg radio for years that America has the privilege, the unique privilege of acting recklessly. Are we losing that?
Not yet. We have a long way to go. We have lots of examples around the globe of people who have acted recklessly for a much longer period of time than we have been acting recklessly. But we also have obligations that others do not. Right now, we are the beneficiary of being the strongest economy, the strongest capital market, the strongest military, and the best place to do business. I mean, if you tick off what's happened over the past years here, we may not like how we got here and how we financed it. 3 years ago, we decided to build infrastructure. We allocated $2 trillion. None of that's built yet. It's all being built. 2 years ago, we spent $52 billion of semiconductor subsidies to build semiconductors here. Not a single plant is open. It's all being built. A year ago, Inflation Reduction Act to encourage the manufacture of renewables. 1.3 to 2.3 trillion, no one really knows. Not a single plant is opened. We are the beneficiary and the largest recipient of foreign direct investment 3 years in a row. So people around the globe are actually figuring out we're better off here. And something tells me we're ramping defense production. All of those things are fiscally stimulative and positive for employment. Oh, by the way, we have no illegal immigration. This sets us up very well fiscally for a strong economy, which I think we're seeing.
Federal Reserve is cutting interest rates by 50 basis points. Are you in Torsten's slot camp? And you can agree or disagree with Torsten, of course. Torsten works here. He believes this economy doesn't need rate cuts. We're in a great place. Do you share that view?
I said it right. I was, I guess, unfortunate to be on TV an hour after the rate cut. I said this was a very, very expensive insurance policy.
What's expensive about it?
The notion that we would cut rates. Financial markets are wide open. Equities are at all-time high. Financing is available. Real estate prices are going up in every market. And yet we're stimulating, and we're stimulating fiscally. It is not clear that we need more rate cuts at this point in time, and to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter, to the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now. So am I in the Torsten camp? I'm absolutely in the Torsten camp, and it's my privilege to have him down the hall. I make sure to check in with him every morning.
I do as well. Mark Ryan, this was a privilege, a pleasure. Good luck for the next 5 years, and I hope to talk to you every year.
Every year you get to do it. Thank you.
Mark, thank you, sir. Appreciate it. Lisa, we'll come back to you in the studio here in New York. Thank you.
John, great work. Fascinating interview, very wide-ranging, from the political sphere to the change in markets, the idea that people will be talking about equity that is private, not private equity. John, wonderful work. Thank you so much. A lot of interesting moments there, Anne-Marie. I know that you picked out one in particular with respect to the deficit. He didn't talk about, Mark Rowan didn't talk about which candidate he does support by name. He did say you're either scared of 4 more years of the status quo or 4 years of change. He personally is more scared of 4 years of status quo because of how much the U.S. is spending versus what it is actually saving and preparing for the next generation.
And from where he sits, he's saying that he's not seeing yet the benefits of that spending, and he says that the U.S. right now, there's no governance when it comes to the fiscal spend, and we are just wasting our children's futures. His words. It was interesting, though, because he didn't name names, but he clearly was backing one camp when it came to the Trump camp, because he said, you're either scared of status quo, scared of 4 years of change. Also very interesting, expensive insurance policy, the most expensive insurance policy when the Fed came out and cut 50 basis points.
Yeah, sitting basically where Torsten Slok is, saying that essentially this is not an economy that needs some sort of stimulative, pre-active insurance cut, given how much momentum there is currently in the labor market. This is highly disputed. We heard Neil Dutta yesterday, Renaissance Macro, coming out and saying the Fed should cut by 100 more basis points. The case is obvious. You have people on both sides of the map. Taking it back to markets, what we're seeing is a little bit of a weakening across the board, led by small caps, and actually the Russell 2000 continuing to decline, deepening those losses, down 0.8% on the heels yesterday of both some labor market indications that were weaker than expected and the turmoil that we're seeing overseas in the Middle East. We're talking in particular about that quits rate that came in from the JOLTS report at the lowest going back to 2020. Also some weaker than expected trends in the ISM manufacturing data under the hood when you look at the employment factor. I wonder how much this is really driving the bus, Anne-Marie, when you look at the action. And a real question here about whether you can continue to see a broadening out in the equity rally if you don't have that same kind of strength continue, at least in the day-to-day data.
What we saw in the data, I think, was reflective of what we recently saw on the conference board. And this is what Oxford Economics was talking about, the quits rate falling to the lowest level since the pandemic. The decline is consistent with other data showing workers view the labor market less favorably. That idea is, are jobs plentiful or are jobs hard to find? We'll get a better read on Friday. Of course, we'd like to talk about the fact that you pretty much need to slice off maybe 60 or 70K because of revisions. But I still think the next labor market report the two is going to be so much more interesting because of how difficult it's going to be for the Fed to maybe read because of all the issues that are happening when it comes to Boeing, when it comes to dock workers, and of course when it comes to the hurricane.
In the meantime, what you're seeing in the bond market is a little bit of a lift in yields, even though you are seeing a bit of a risk-off tone, sort of the opposite. Wei Li was talking about this earlier, how it's an unpredictable diversifier when you take a look at the bond space. 10-year yields up about 3 basis points, 3.76%. The 2-year yield up just a basis point, 361.47. A real question here about how much people can pile into bonds, given how much we've rallied and given how much of a rate-cutting cycle we have already been pricing in. That is going to be a key question going forward, especially given some of the other side of the aisle, which is actually what Mark Rowan was talking about, this idea that we are seeing a no landing, right? I mean, how many people are coming out and saying, look, this isn't an economy that's that weak? At what point do you start to see the bond market reflect that maybe it's hitting up against its limits?
And to Wei Li's point, when I pushed back on the fact that it's obvious from the Fed's point and Jay Powell's point, they care a little bit more about the labor market right now. They don't want to see the deterioration when it comes to jobs. But there is this concern from some individuals in the market that you could see a reacceleration of inflation. And the stories right now do not bode well for that potential scare when you think about what's going on in the Middle East and the fact that we did see a jump in oil prices yesterday, even though there seems to be some ceiling on how high they could go. And then, of course, potentially supply chain bottlenecks that are coming out of the East Coast.
Meanwhile, what you see in the currency space is kind of a confusing picture, although dominated by Japan, given the fact that the new Prime Minister, Shigeru Ishiba, came out and actually tempered expectations for further rate hikes, saying that the emphasis has to be on the strength of the economy. What you are seeing is the dollar strengthening versus the yen, ongoing yen weakness after a bout of real yen strength, 144.74. It's not massive, which I actually find interesting. So it really highlights maybe a positioning equilibrium that we didn't see maybe a couple of weeks ago.
You got to think all in a day's work. Brand new prime minister, 24 hours, got to call the president of the United States and got to make, maybe some potential moves in the currency market.
Well, in fairness, if you think of the decade or several decades of disinflation or deflation, you understand why they're so focused on this. We'll carry the conversation forward. Coming up, Kristen Bitterly of Citi will be joining us, Anisha Sherman of Bernstein, Joe Davis of Vanguard, Tony Rodriguez of Nuveen, as we count you down to non-farm payrolls on Friday, leading off with ADP in just about 15 minutes' time. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. When I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Stocks have been benefiting from this whole view that rates are going lower.
As much as the data becomes more and more muddy, there's a risk that continues or even exacerbates over the coming months.
While we're not expecting a significant slowdown now, we do think you're coming into a third quarter low.
We do think that the economy is much stronger than people expect.
The upside opportunity here is tremendous.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. John is hanging out at the Apollo's food court for just a little bit longer. Still in the room is Anne-Marie Hordern, as well as Danny Berger. Thank you both for being here. I am looking right now at a market that is slightly soggy ahead of that ADP report in about 15 minutes' time. Let's begin. Let's get into it. This question of just how weak or strong is the labor market, that is the focus. Possibly, Danny, what's driving down Russell futures, given the fact that that was really the main message that came out of yesterday's report.
I'm just interested in what happens to yields. I think you put it so right at the end of the last hour that we retained this risk off except for bond yields. Is it just a feeling that so much is already priced in, that we have crisis era type curve already? So what does that mean if we get weaker jobs data? Does it initially lead to, okay, we rush and buy bonds, and then we kind of say, hey, maybe everything's in here that we can be? What will be the reaction? Are we just set up asymmetrically at this point?
That's a great point. Asymmetric. Is there an asymmetry right now in markets? Because we have baked in so much of a rally in bonds. Yesterday, a lot of people flirting with the idea that maybe we saw bonds act as a stabilizer, that they were actually the haven asset, not only with the weaker economic data, but also given the fact that there was this disruption in the Middle East. You saw oil prices tick up, might be inflationary, but you still saw a flight, at least on the margins, into bonds. Anne-Marie, there's a question here about how much this market is accounting for or discounting some sort of potential escalation.
Yeah, and there's really three main stories right now that can affect the U.S. economy: the hurricane, the dock workers, and then, of course, this geopolitical tension in the Middle East. And we are still waiting on a response from Israel. So potentially you're seeing some of that risk definitely baked into the oil market. And it's a big question mark on whether or not it ends here or does it escalate further.
And at a certain point, you start wondering about that. Danny, I know you're very familiar with the dock worker strike. You spent all of yesterday and the day before hanging out with the seagulls. How was that? Was that fun?
Too many birds.
Yeah,
honestly,
many birds.
a terrifying amount of seagulls around there. But no, it is a feeling that the sides are moving closer together, and maybe something will happen that makes us forget about all this. It's the trend of really the past 2 months. August, you start with bad news. There's the risk of a hard landing. September, it was inflation. And then at the end of both months, you get this big risk on rally. Is this month the same, where we start worrying about geopolitics, we worry about the dock workers, and then next thing you know it's risk on yet again?
Well, we heard from Bloomberg Economics, Anna Wong, talking about the fact that this might mean 80,000 off the payrolls, and that could boost the Fed to go in with a 50 basis point cut. So this could mean from dock workers to the Fed, there's actually an implication.
All I can say is you wait 2 minutes, we'll get another narrative, and we'll be tracking all of them for you here on Bloomberg Surveillance. Coming up this hour, Kristen Bitterly of Citi Global Wealth Management as a risk-off mood grips markets. Anisha Sherman of Bernstein, as Nike Nike scraps guidance amid its CEO shakeup, and Joe Davis of Vanguard on the loss of momentum in the U.S. labor market. Let's begin this hour with stocks on hold. Investors keeping an eye on the Middle East and awaiting more U.S. labor data ahead of payrolls Friday. Kristen Bitterly of Citi is saying this: geopolitics and elections are big concerns, but not really driving investment decisions. Reinvestment risk is becoming more real. The 50 basis point cut actually mobilized a lot of capital. Rolling T-bills is becoming a difficult strategy to compete with the returns that we have seen in equities, with further broadening out. Kristen, I am so pleased to say, joins us now. Kristen, is this basically an argument to all of those people who have $6.4 trillion in money market funds to say, really? Really? Are they actually moving?
There is a lot of cash on the sidelines, and we've actually seen a substantial amount just within portfolios. And I do think it makes sense. Cash was a viable asset class, and we needed some movement from the Fed to actually start looking and analyzing the rebalancing decision. So what have we seen from investors? We've seen them coming into equities. We've seen them coming into the fixed income market more broadly, whether that's in munis, in investment grade corporates and extending duration, or in preferreds. But I think what happens is, in a lot of our conversations, people will talk about geopolitics, they'll talk about elections, but then they take a step back and they say, earnings are at record highs, rates are coming down, inflation is coming down. And then I would even add what China did last week, not saying that we're seeing retail investor flows go into the Chinese market, but more that it's one more thing, one more tailwind.
You know, I do wonder, though, I mean, just to sort of put this in perspective, we're about 10 minutes away from the ADP employment report. Yesterday, we got quits data underpinning the JOLTS information that highlight that people aren't feeling comfortable to quit their jobs in the same levels that they were back in 2020. Does that give you pause?
I think the labor market data that we've seen thus far has actually, and I agree with Chair Powell on this, there's some slowing, but it's not contraction. It's not deterioration of the labor market. And so Friday is going to be really important. I think payrolls are going to be one data point that everyone's watching, especially because what the Fed is telling us is that inflation, that battle has largely been won. So now all eyes on the labor market. I do think, though, there are so many things that will go into that data, whether that's what Anne-Marie actually just mentioned a little bit ago, whether it's the dock workers strike, what we're seeing with the impacts of the hurricane, what we're seeing with various strikes. So there's a lot of noise in that data. And the question is, does the market and the Fed actually look through to that noise and understand what the real picture is?
What are you telling your clients? Should they be looking through the noise? Should they care about the labor market data? Or should they look at China, maybe 100 basis points of cuts this year, and say, hey, go full on bullish?
I actually think there's opportunities both within fixed income as well as equities. And when you look at our portfolios, they are very balanced. I think everyone looks at October, and we could discuss this ad nauseum. October tends to be a volatile month going into election years and tends to be a negative month. So whether that's elections, geopolitics, we could debate that. But I think when you look at, like, what is your plan for your portfolio, there are opportunities within fixed income markets, whether that is munis, whether it's preferreds, whether it's investment grade corporates, and finding opportunities in extending duration. Within equities, we have been playing this broadening out story, but still leaning into quality. So for example, an area of the market that has been left behind, dividend growers. So strong balance sheets, strong free cash flow generation, but they haven't been on like either side of high-flying tech companies or when small caps catch a bid. So for anyone looking to kind of hide out and still have equity exposure, that's a great place to be.
For every tailwind you're talking about, there seems to be a risk, though. The geopolitics in the Middle East, the election uncertainty, it's on a knife's edge, Boeing, dock workers, hurricane. Where else do you think you can hide before what is potentially going to be a very few long months or weeks when we might be questioning the outcome of this U.S. election?
So I think the U.S. election, we always say that it's policy, not politics, that are going to drive any type of investment decision. And so what we've tried to do for our investors is say, like, what is the playbook, right? So you basically have three different outcomes in the election, whether that's a Dem sweep, a Republican sweep, or what most people think is going to happen is some type of divided government. And then you look through to, well, what are the changes that could actually happen? And it's tariffs and taxes. And so for each one of those areas, you could have slightly different positioning within your portfolio. But what I just mentioned in terms of what is a way to stay invested in a relatively, you're involved in this equity market that we've seen, but you're doing so with a balance to fixed income as well as equities. And you do have a bias towards some of those areas that are quality that have been left behind. And I think that's a very effective way to be hedged, but positioned going into the election.
In the aftermath of elections in Europe, we've seen one real trend, and that is taxes. The UK, there's a lot of language about carried interest tax. In France this morning, we understand that they are going to also announce additional taxes, trying to tackle the deficit. Michel Barnier, the PM, called it the real sword of Damocles, is the financial burden from the deficit. Are your clients worried about, after an election, the same thing happening to the US, that there's a serious conversation about the deficit and wealth planning needs to look different because of potential taxes?
So I think the major conversation that we're having, taxes certainly, and what happens when we get that expiration at the end of 2025, and what that could mean for personal taxes, what that could mean for corporate wealth taxes, dividend income taxes. So there's a lot of discussion around it. But one thing that I think is actually a pretty fascinating stat is you can worry about what those outcomes are. You could worry about what a divided government would do. But I actually look much more basically at the fact that only 1 out of 3 Americans has a will. Like, only 1 out of 3 Americans has actually gone through a financial plan. So when you think through what could be some of the biggest events in terms of impacting your overall wealth and the taxation of that, it's not just what you're invested in, it's how you structure it. And so I would say almost focus more on the basics that are in your control, not this outcome that is something that we still don't know and it's still uncertain. So be prepared for it and be prepared by actually taking control of those things.
Basics like 60-40, basics like having some sort of longer-term risk exposure. This is sort of at the heart of the question that Anne-Marie and Danny is getting to, which is essentially, do you still go to the traditional 60-40 at a time when you do have the deficit as a concern, where you do have potential more volatility and inflation and potentially geopolitical tensions? How much are you advising clients to diversify away from bonds as that ballast, as we were just hearing from a number of different people, including Wei Li earlier this morning?
I think everyone's situation is unique as to what is their starting point. And so if you look at different profiles of investors, we do see investors who are significantly overweight cash. What do we know is if rates are going to continue to come down, cash is not a good performing asset class. And so that conversation is going to be one where you're trying to find opportunities within fixed income, because someone who's been significantly overweight cash, they're not going to jump into the equity market. They're not going to jump into alternatives. So I think you have to be realistic about what does it look like to get you to better financial outcomes over time. But certainly for investors who are looking through to the equities market, we see a lot of balances where it's 60-30-10, where it's, you have a position in cash, you have a position in bonds, and then you're benefiting from the equities market. And I know that you guys just had the conversation with Apollo too. I think another interesting thing is the relative perceived riskiness of adding some things like alternatives. When you actually look through even to the fixed income market, once you get beyond some of those very, very liquid instruments, there's a lot of illiquidity within the bond market. So you have to think about what is going to ultimately generate the returns that I need to achieve my objectives. And alternatives are certainly an important part of that as well.
Kristen Bitterly, don't be a stranger. Thank you so much for being with us. Kristen Bitterly of Citi Wealth Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. JP Morgan is planning to open new branches across low-income areas in the U.S. The Wall Street Journal reporting the bank is working to build around 100 new Chase Bank locations in America's inner cities and rural areas where the presence of banking has been shrinking. The push is being described as a way to offer a more stable alternative to high-fee services, such as check cashers and payday lenders. Less than a month after its big Glow Time event, Apple is already preparing for its next product launch. According to people familiar with the matter, the company is preparing to announce a new low-end phone early next year alongside upgraded iPads. The new iPhone SE, codenamed V59, will become its new entry-level model. The release will mark the first update to the SE since 2022, when Apple added 5G capability to the device. This will be very exciting to people who have kids and need to replace them. And you could own a piece of GOAT history. Super Bowl champion Tom Brady will sell 47 pieces from his collection of watches and sports memorabilia to Sotheby's, New York. The pieces will be sold at an auction on December 10th and are expected to sell for up to $11 million. Which of you decided to put that in the brief? I'm just wondering, did you end up buying this?
These watches.
Yeah.
This Patek Philippe is pretty nice, but I love what Tom Brady says here. I'm excited to give fans and collectors a chance to own and cherish these special pieces from my journey.
Because I'm sure so many fans can afford that.
I'm sure. I would love to give you the opportunity to experience my life too for $11 million. Up next, the morning calls plus Anisha Sherman of Bernstein as Nike begins its C-suite transition. That's coming up next. This is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
It's the moment you've been waiting for. We got the ADP report, and with us here is Michael McKee to break it down for us. Mike, drum roll, the big ADP report. What did we get?
Better than expected.
Oh,
how's that?
Great.
Does that live up to your
Fabulous.
expectations there? ADP comes in at 143,000 private sector jobs for the last month. That's up from 103,000 revised for the month of August. Most of that seems to have come in the service providing sectors, as one would expect, 101,000 jobs there. Leisure and hospitality, 34,000. Education and healthcare services, 24,000. Now, the leisure and hospitality is interesting given the seasonal aspects of it, but that's what they say they found. Construction, 26,000. That's still adding workers. There's still a lot of demand for construction workers. Manufacturing, they say, added 2,000. They've seen a lot of deterioration in manufacturing hiring, but we haven't really seen that overall yet. Their pay indexes, job stayers saw their pay go up 4.7%, job changers 6.6%. So for whatever it's worth now, we look forward to, on Friday, the payrolls report. Remember, this is only private sector jobs, and private sector payrolls are forecast to go up 125,000 on Friday. So ADP coming in more optimistic than the economists are about the non-farm report.
Right now, seeing in markets a little bit of a pop, but particularly at the front end in terms of yields, lower on price as people look at what the potential is for the Fed to make a move with this outside surprise. Not a big amount of drama. Let's just be really clear here. You're basically seeing a lot of fading pretty quickly of this move. But I do wonder how much, Mike, to Anne-Marie's point, the newfound love for ADP that somehow is more closely correlated to what what the revised numbers look like out of non-farm payrolls than, say, non-farm payrolls.
Well, it's like that meme of the guy with the two women and he's looking to the other one when he's with one. ADP was nothing, and now all of a sudden, because the Fed says it's watching ADP, it's watching the labor market, then people are paying attention to ADP trying to get a beat on what might happen on non-farm payrolls. But the ADP people tell you straight out, this is not a forecast. This is just our own number that we get.
To that point, Powell on Monday, I thought the really interesting part of his discussion was when he basically was talking about the tension between consumption and labor markets. And he basically said, look, we care more about the labor markets. They give more of a real-time indicator than something like GDP, which historically can't call recessions very well. With that in mind, does it mean we need to pay more attention to ADP? How should we, trying to get in the head of the FOMC, approach all of these labor market data points?
Oh, all the labor market data points, as you say, most of them you can ignore. The ADP gets traded because it gets traded, and that's just been its history. And it doesn't, as they say, predict what will happen with non-farm payrolls. And even if it did, it's the non-farm payrolls numbers that's going to matter. And it's usually, unless there's a clear trend, it's usually the payrolls report before the Fed meeting. And we get that November 1st, the next payrolls report. And as Anne-Marie was saying earlier on the show, that one could be all screwed up. So that could be hard to read. So I would look past this. We'll see what happens on Friday, and we may end up looking past that as well.
Michael McKee, don't be a stranger. Thank you so much for being with us. Always great to get your insights, and you are seeing that sell-off in the bond markets continue just marginally on the heels of that ADP report. Time now for In the Morning calls with just one stock in focus, Nike. First up, CFRA downgrading the company to hold, citing increased competition and lack of growth drivers. Next up, JP Morgan lowering its price target to $77 and keeping a neutral rating, saying turnaround plans are taking longer than expected. And finally, UBS raising its price target to $82 while maintaining a neutral rating, calling recent weak earnings unsurprising and saying the risk-reward is balanced. Joining us now, Anisha Sherman of Bernstein, sticking with an outperform rating, saying this: though we remain positive long-term, we expect the stock to stay in limbo short-term without a guidance clearing event or investor day catalyst. Anisha joins us now. Anisha, explain. There's so many people who are so bearish on Nike, especially at a time where they're withdrawing guidance, seeing another significant decline in their sales in the third quarter. How are you bullish?
Nike is in a very different place right now than it typically is in the cycle, as well as a stock. Sentiment is extremely low. It is an extremely uncrowded long. It's actually at the bottom decile of our crowding analysis, meaning it's the bottom 10% of uncrowded longs. And so this stock is poised to rebound on any signs of good news. And we saw that happen over the last few months. The stock's been up almost 20% in the last couple of months on expectations of a CEO change and then the actual announcement of the CEO change. But, you know, it's where it's at these levels, any kind of incremental good news helps the stock. The problem is right now the CFO is just wiping the slate clean ahead of the new CEO. So there's no guidance, there's no investor day, or the date hasn't been reset yet. And there's no one in charge. There was no CEO on the earnings call last night. So essentially the message from management is we got to wait until there's somebody in charge again, and then we'll give you some clarity on the upcoming catalysts. And so for now, I think the stock stays a little bit stuck at these levels. But I do think over the next 6 to 12 months, there's some really nice upside as we start to get clarity on the numbers.
Anisha, I just wonder what you make of that strategy. It's almost as if they're like, we don't know what we're doing, and we're just waiting for a savior to drop down from heaven to save us. I mean, is that the right thing, the right approach for Nike to be taking at this moment?
I absolutely agree. I think it was widely expected that the investor day would be postponed and that guidance would be cut. However, the investor day has now been postponed with no rescheduled date, and the guidance has now been completely pulled. And so rather than having rebased expectations for the new CEO to come into, we now have no expectations. And so it's more of a black box than a clearing event. And that's, I think, the issue is I would have liked to see them cut the guide and not just pull the guide entirely. And I would have liked to see a new date set for the investor day so we have a clear idea of the catalyst path. And now we just don't.
But Anisha, what if that next catalyst is deeper into the abyss and not to the upside?
It's possible, but I mean, if you heard the commentary on the call last night, it sounds like there's a lot of upcoming signs of positivity. They're getting better retailer feedback. They're getting better order books for the spring than what they had in the fall. They're seeing their running products coming back and getting double-digit growth in order books. So they are seeing improvements. The problem is they're still doing a ton of clearance on the big lifestyle franchises, on Jordans, on Dunks, on Air Force Ones. So that is an overhang on the sales performance. So until that stops and clears away, we're not going to see that underlying performance work. But the market is going to look for signs of that underlying improvement. And as we start to continue seeing signs of that underlying improvement, the stock will work before the sales performance does.
I'm a runner, Anisha, and I see it firsthand. There is a war among running shoe providers, and you can see that it right now is being won by the likes of Hoka and On and Asics, if you're me. But I do wonder, from your vantage point, how successful a Nike is going to be and who they're going to get market share back from if they are successful at getting back into the running sphere.
Nike has lost a ton of share in running. We estimate they've lost 1,000 basis points of share, but they're still the #1 running brand. I mean, they were close to 30% market share, and now they're below 20%. And the gainers have been, as you said, Hoka, On, Asics, and some of the smaller brands like Brooks and maybe a little bit of Saucony as well. Where they'll get share from is they'll recapture share in some channels. So the running specialty channel, they are completely at almost 0% market share. That's where they need to regain some share. The losers there will probably be Brooks, and then to a lesser extent Hoka, because those are very heavily penetrated in that channel. And then I think it's all about consumer choice as well. Like if they put a more compelling product out there, the incremental sale may go to a Nike rather than Asics. I don't think they'll go back to 30% market share, but having lost 1,000 basis points, there's a nice room for at least several points of recapture in that segment.
Are Jordans still cool, Anisha?
Not as cool as they used to be, unfortunately. They've leaned too hard into Jordans. Too many people bought Jordans over the COVID period, and so you're kind of up against the success of the franchise over the COVID years. But also because they over-distributed that franchise, it's not as cool and has as much scarcity value anymore. And that's what they're trying to recapture. They're trying to clear out some of the stale products within the Jordan franchise and try to recapture some of that heat and that scarcity value that makes Jordans cool again.
Anisha Sherman of Bernstein, thank you so much for being with us. Man, humans, the way that people are it's just so predictable.
I still think Jordans are cool.
Okay, so basically you're one of those people that thinks that if there's saturation, that doesn't mean automatically that they're not cool anymore.
I'm not a collector, but they're classic, right? Like, they're classic. You're never gonna get rid of the Jordan brand.
Unless there's like too many of them, you can go to a discount store, find them. They become uncool, Anne-Marie. It's about that short supply.
Okay, right. Well, all I can say is the resale market definitely does show that. Coming up next, not bad. Joe Davis of Vanguard joining us, and Tony Rodriguez of Nuveen, as we do parse through the jobs data that we just got and looking ahead to jobless claims tomorrow, as well as what we see, of course, on Friday. Right now, about the same sell-off in S&P futures, down about 0.25%. Good morning.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Some heated discussion around shoes right now. 1 hour away from the start of trading day, you can see essentially that weakness carrying through, even though you did get better than expected ADP numbers. You do have that weakness continuing, led by the Russell 2000, still down about 0.8%. Right now, though, let's get some morning movers. Manus Craney sitting there with them all. Manus, what you looking at?
Lisa, we're going to kick it off with oil. You've got the product itself up nearly 6% over the past 2 days. So this is carrying through into all of the big oils. Exxon, Chevron here up 1.74%. The debate is this, the calibration of the response from Israel to Iran. And Monday we're with this morning, and they say, look, this is tit for tat. Until they go for the oil infrastructure or whatever, you're not going to see any further reverberation, and that's highly unlikely. But at the moment, big oil is bid up yesterday and rebid this morning. The Saudi oil minister, of course, putting $50 oil back on the mindset of the market. Roll it over and have a look at Alibaba. I put this ADR up here because we've got this FOMO gripping us around the world in regards to China. Are you in? Are you under allocated? Chinese stocks are trading at a 30% discount on a price to book value relative to their EM peers. And the conversations that you had on surveillance yesterday, which was about US fully valued pickup opportunities in China. Either way, mortgage rates are lower, and these big players on the ADR market are bid here in the US this morning. I'll leave you with a look at Humana. You look up the ratings for your holidays, for trains, for cars. Apparently when you're over 65, you look up the rating on your healthcare plan, Medicare Advantage. The ratings drop on the Humana Medicare Advantage product. This is for the over 65s. The ratings drop, and so too do the numbers. 1.6 million customers. That is down by 94%. Ratings matter, not just in the airlines, Lisa, but on your healthcare package. Good morning.
Good morning, Manus. I like how you specify that. If you're over 65 and you're looking at ratings, well, we'll all get there at some point. Meanwhile, ADP out just moments ago. Investors now looking ahead to jobless claims and September payrolls. Data from Vanguard showing that large U.S. employers are hiring at the slowest pace since June 2020. The team at Vanguard writing this: we expect this softening of the labor market to gradually dampen consumer confidence and real wage growth, resulting in below-trend GDP growth in the first half of 2025. Not necessarily a calling for a bearish take. Still, nonetheless, joining us now to explain, Joe Davis, chief economist at Vanguard. Joe, thank you so much for being with us. I want to start just with weakening but not weak. How do you parse the difference at a time where we definitely are seeing weakening?
Well, sure, and again, I think that's also really at the heart of the Federal Reserve's response. So we've clearly seen a slowdown in the labor market. Part of that's been very welcome. I mean, we were out of balance for the past 2 years and had, really rapid wage growth. We're approaching the levels now where any further weakening or just slowing or cooling would really put, really bigger concerns on the table. I think the Federal Reserve has been weighing this information very importantly, and so, really explains announced, some of their pretty aggressive moves. I mean, I think the big tension in the market is, are the jobs figures really representative of the strength of the economy, or is it things such as GDP growth, which is going at 3% and not showing any signs of a slowdown?
So which is it, Joe? I mean, we just had Apollo CEO Mark Rowan speaking with our own Jonathan Farrow, and he was basically saying that the 50 basis point rate cut was a really expensive insurance policy, and that actually this is not an economy that needs it based on GDP and based on earnings. What makes you think that the labor market data, like the underpinnings of JOLTS that show that quits rates have really gone down, what makes you think that we should more heavily weight that?
Well, again, I mean, I think the whole insurance phrasing is actually pretty appropriate. Again, the economy is pretty resilient. I think we still have some turbulence ahead. Our lead indicators, which you mentioned at the outset, still point to some further weakness, and they're pretty powerful indicators given just the breadth of our sample. And so I think what they're trying to do, again, let's be clear, the Federal Reserve is all in on the soft landing expectation, and so I think they're going to be fairly aggressive to try to increase the odds that that happens. But there is risk in that strategy if the labor market, which I don't think it is, but if the labor market is sending the false signal and it's the GDP numbers that are more accurate or more representative, then 6 months from now we're going to have this crossroads, because the equity market, I think, is looking at GDP, and the bond market and the Treasury market is looking at jobs.
Well, Joe, Powell tried to solve this tension by just saying the labor market is a real-time indicator and GDP is not. GDP is historically bad at predicting a recession. Does that mean that we just can completely discount it, completely discount the strength and what it tells us about, one, inflation coming in and the likelihood that unemployment moves in a more malicious manner?
Yeah. I wouldn't be too quick to completely discount GDP, because underneath GDP is corporate earnings, corporate profits, business investment, and so I think it is important. I mean, again, I think policymakers, to be fair to Chairman Powell, I think they are looking at a distillation, but there's no doubt that the Federal Reserve is weighing the jobs market much more heavily than the GDP numbers. Again, I think the next several months will have some weakness. If we're right, then the Federal Reserve will look very prescient. But nevertheless, we're coming at a modest crossroads. I'd say roughly 6 months from now, and that is, and it's not a bearish crossroads. It's more of, is the equity market right, and this softness in the labor market is going to stabilize, and then we're following GDP, or is it going to be the latter, and we're going to have GDP come from 3 to 2? I wish I had more conviction of which one it's going to be. Policymakers are trying to change that calculus in the next several months, but that is really the heart of the issue.
I love the way that you're phrasing this, because it's really accurate. It makes me feel like right now the labor market's going to dictate the bond market, and it's basically the GDP numbers. Atlanta Fed GDP is what almost every analyst who comes on the show who's bullish on equities points to and says, look, what slowdown? I just wonder how much the Fed could get ahead of this in economic terms. In other words, if they just cut by 50 basis points, if they do another 50 basis point cut, say, in November, how much could they affect change to actually bring the labor market up to GDP and GDI, rather than bring GDP and GDI down to the weakness that we're seeing currently in the labor market?
Well, again, I think there are recent actions. There is some lag. So, I mean, the financial markets respond instantaneously. We're already trying to get ahead of the Federal Reserve. But in terms of the labor market, the next 3 months, they're pretty much baked. I actually wish I knew exactly what the numbers would be, but our leading indicators say, listen, there's still some choppiness, but they're not going to go negative. That would be a surprise to me. And so, again, I think where it's going to come out, the Federal Reserve is now trying to look 6 months out and saying, listen, we want to nail that landing. The only risk, I think, the more bullish part of the economist or analyst community is saying is, listen, you don't need to be cutting at all or not much. And so I think the Federal Reserve, if they're going to fight that narrative, they have to explain why they believe they're so restrictive and yet we have 3% GDP growth. I'm still waiting for the answer, but I think that's something that would be helpful for the Federal Reserve to articulate where they're going to go for the next 6 months.
Joe, but how are you going to review the non-farm payrolls report November 3rd that's looking back at October, when you see all these mismatches in the economy and people will be out of work? We know that because of what's going on with the number of strikes in Boeing and the ports.
Well, again, I think you have to look at other things. I think you have to look at the new entrants coming in. I mean, one of the biggest reasons why we didn't have a more material slowdown this year was just really the surge in immigration. So you're going to look at a distillation picture. It's not so much what the headline is, it's the breadth of job creation. It's industries that are always strong. Are they continuing to add at a current pace? It's the hours being worked outside of those strikes and areas. So again, like anything in life, there's going to be noise in that report. I think what you're trying to say more than anything is the diffusion or the breadth of industries and companies that therefore they're continuing to add to just the jobs.
Joe, you also talk about something in your research, a phrase that feels like it's been dropped by the wayside as of late, and that is the last mile of inflation. That's some of the unevenness that you see. You expect inflation to remain stubborn in the second half of 2024. Does that mean this whole sort of idea that Powell was doing some sort of victory lap, even though he didn't explicitly say it, saying that inflation has been conquered, that's not exactly right?
Well, again, I think the Federal Reserve, they're one of the few institutions that can actually affect the outcome because if everyone believes that inflation's under control, it tends to go their way. But, the housing market and all of its esoteric calculations has been, one of the areas that's really been stubborn. And I think that, even Fed officials would acknowledge that. But again, this is a fairly dovish institution, but to give the Federal Reserve credit, they said that they could have a trade-off of bringing down inflation without a material impact in the labor market. Now, to counter, they got a really good luck in terms of the immigration surge, but tracking to date. So again, I'm not cheering against the soft landing. I'm just waiting to see, where does that calculus, given their aggressive cuts and what likely will continue for a little bit of time, where are we 6 months from now? And that's something that we will continue to focus on.
Joe, before we let you go, how much are you expecting the jobs report to surprise to the upside or the downside when we get them on Friday?
Oh, my goodness. I've been employed for 22 years, in part because I've tried to avoid these questions. But I would say there's modest risk on the downside, but take that with a grain of salt. If I was that accurate, I would probably already be retired.
I love it. I expected you to be like, whoa, suddenly disturbance, can't hear you. Joe Davis of Vanguard, thank you so much for being with us. We really appreciate it. In here, in the studio with us, joining us is Tony Rodriguez, Head of Fixed Income Strategy at Nuveen. And what do you make of that? What we just were hearing about from Joe, that essentially the bond market's taking its cues from the potential weakening of the labor market, whereas stocks really are looking much more at GDP and GDI.
I think that's accurate. And I think when you take that to the fixed income context, you're seeing the equity-like response in the credit markets, right? So emerging markets are doing well, preferreds are doing well, high yields doing well. So credit risk is highly valued right now, and the fundamentals are very solid. Defaults are low, corporate profits are good. So you're seeing the same story in the fixed income market. It's just that it's focused on the credit sectors. So I think the disconnect is maybe that in the treasury market, you are seeing people that are kind of hedging against their risk book. So if you have an aggressive equity position, one of the only things that's going to work well, if in fact we get the hard landing, that's not the highest probability, treasuries will rally, treasuries will serve as a hedge. So I think there's a lot of money in that market that is serving as a hedge to taking risk in the credit markets, taking risk in the equity markets, private markets.
That didn't work, though, over the past couple of years because the risk was inflation, and the different kinds of risk can mean that the bonds can be a buffer or not. Are you basically saying that increasingly bonds are a diversifier because inflation is off the table, that is no longer a concern in any investor's mind that you speak with?
Essentially, yes. I mean, we wouldn't say inflation risk is off the table completely, but it's certainly much lower risk than it had been. We do think inflation continues to come down. So when you think of fixed income, you want to get income out of it, liquidity, and a hedge and stability. Back when inflation really started to take off in 22, there was no income in it. There was no potential for protection because rates were so low. There was still liquidity. We sit here today and you have income now out of your fixed income portfolio. Treasury is probably the least attractive area to find it, but you do have income in it. And you do have now what we think will be a hedge because you're coming off of 3.5% to 4% type of levels rather than what had been sub 2% levels.
So, Tony, yesterday, we have a big risk-off type day. It's pretty textbook over geopolitical fears in Iran and Israel. It's pretty textbook except for credit markets. Spreads barely move, maybe 1 basis point for the overall market, maybe 5 for high yield. Is it a market immune to geopolitical risk, or is it just more calm investors? What is it?
Yeah, I don't think it's immune, but I do think it's more common investors. Even oil prices, while they went up, they didn't spike as much as you might have expected. So I think people, maybe it's the frog in the boiling water type of syndrome, that all of these geopolitical risks, there are so many hotspots out there, and there has been escalating risk in all of them, that maybe the markets have seen the movie before, and it's going to be, a really cataclysmic event if, in fact, it gets to the point where we start to see really the Mideast theater expand into more players. But for now, I think the market's looking at it as this has just been the ebb and flow of this, continuing escalation that we're seeing. So we haven't had a major disruption, but it's a big risk out there in our minds, is that geopolitical risk.
Yeah, so if you were going to take that risk on board and you were actually really nervous that this was a different movie than the one we've seen, what should you be doing?
Well, from our perspective, there's a couple of things. One is that you don't want to be at the high end of your risk budget. When you look at not only the risks that are out there, but when you also look at just valuations in the broader capital markets, right? Fixed income, you look at credit spreads, equity market, you look at valuations. None of them are considered, historically cheap. They're at best case fair, maybe aggressively priced. So that tells you want to have some powder dry. You want to be kind of at the midpoint of your risk budget. In addition to that, within all the various asset classes, we're leaning more towards a little bit higher in quality, a little bit higher in liquidity, and making sure we have stronger fundamentals that can kind of see their way through any potential, impact from economic weakness coming from a geopolitical event.
There's sort of this counterintuitive feeling right now in markets. There's a real question. We were talking with Wei Li of BlackRock earlier this morning, who agrees with her colleague Larry Fink, who was talking about that maybe this bond market has priced in too many rate cuts. At the same time, that people are talking about the potential for downside surprise that inevitably the Fed would respond to. Do you think that there has been sort of an overstating of the Fed's reaction function? In other words, a more bullish position on the economy? Or do you think that people are going to be surprised by how much they are going to have to cut?
No, I think that the markets are pricing in too many cuts. So there's been an overstatement of that. I do think that the probability of soft landing increased quite a bit when the Fed cut 50 as their initial cut rather than 25. And also when you saw what China has done over the last week and change, where again, they're not game-changing things out of China, but they are stabilization and first step moves by China. All of that helps to reduce the risk of hard landing. So to us, the Treasury market, the Fed funds futures market, aggressively pricing. Part of that, though, is because there are flows in those markets that are hedging. They're using that market to hedge. And we do think that if you get a hard landing, a very significant geopolitical escalation, the Fed's not going to stop cutting at 3.25 to 3.5, which is what our target is for the middle of next year. You'll see a sub 2% funds rate. You'll see a 10-year that's at 2% or lower. Again, that's a very low probability in our minds, but it will be an effective hedge to the declines you'll find in your equity market or the widening in spreads you might see in the credit market.
So if that's the low probability, does that mean base case, just the natural place for yields to go from here on out is higher?
I think base case is range bound. I mean, we kind of think fair value, 10-year, 3.75% to 4% is about fair value. It's a real rate that might end up in that 1.5% to 2% area. And we think that's a good long run equilibrium level. You rarely get to that level and sit at that level. But for now, that would be what we think is a fair value zone. So it's just the Fed that needs to get down in terms of the funds rate, patiently in our minds, not 50 basis point cuts, but 25 basis point cuts. And if that happens, you can get this, sought after soft landing, which can help the U.S. economy grow. We don't think at 3%, but maybe sustain a 2%, 1.5% to 2% type of pace.
What's your call on the payrolls on Friday?
We'd say that the risks are probably to the downside, but not materially. So 100 to 150 we think is the right range.
Tony Rodriguez of Nuveen, thank you so much for being with us here on set. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief. The death toll from Hurricane Helene has topped 150 across 6 states. And the federal government reported 29 shelters are open with more than 1,000 occupants. Biden will visit the region today, making a helicopter trip over the flood-hit city of Asheville. He will also visit a rescue command center in the state before heading to South Carolina. Vice presidential candidates Tim Walz and J.D. Vance sparring over housing costs, immigration, and abortion rights in their first and likely the last debate ahead of next month's election. Both candidates largely avoiding significant gaffes while focusing on targeting the top of the other's ticket. A ring of fire eclipse is on the horizon. An annual solar eclipse will occur today when the moon obscures all but a sliver of the sun. This eclipse will take place mostly over the Pacific, with parts of Argentina, Chile, and Easter Island laying along the path. For those hoping to get a glimpse of the event, please wear glasses, solar eclipse glasses, because they block out ultraviolet light from the sun, and otherwise you could go blind. So really, be careful. And this is my PSA, because this is what happened when we had a solar eclipse recently, and I saw people looking up with 2 sunglasses and thinking that might possibly help them, and it doesn't.
You're not supposed to look directly into the sun?
Okay, but it's actually, you are looking, you know, you think it's surprising, like nobody looks at the sun, but it's obscured, so it's darker, and then everybody's looking up, and then they go blind.
It's dangerous.
Yeah.
Well, it's your natural inclination. You're like, something cool is happening in the sky, let me just look upwards, and you shouldn't do that.
Yeah, I just looked at the light, and now I'm seeing stars. Up next, setting up for the day ahead, this is Bloomberg.
Is the Vivian Tom clientele? Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world. Why do you position your products for this group of women? When I started, designing, I always want to do something that is empower women. When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example. My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful woman's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
We are counting you down to the opening bell. Here is what's coming up as we do see another day of losses. More Fed speak coming up at 10 a.m. from Musalem ahead of Barkin at 12:15 p.m. 50 or 25, maybe they'll tell us. Tomorrow, we'll get another round of jobless claims they're not going to tell us, plus factory orders, durable goods, and ISM services. And Friday, it is the main event, September payrolls. Will you get 150? Will you get 140? Are you not going to predict like Joe Davis because he is not going to try to lock anything down? Maybe going to predict is Bloomberg's Michael McKee, who is back with us. Mike, what's your number?
I would put it in the 150 range, but only because I don't have a better guess than the consensus and the wisdom of crowds at this point. Like I've said several times, it may not matter because the real number that matters is the one we get before the next Fed meeting.
And that's going to be a complicated number because of strikes, because of hurricane impacts. How should we actually be looking at the figures from here on out with that?
Reasons, but it's going to be hard to say how people and how the Fed, how voters, how everybody will react to something 4 days before the election.
Mike, can we talk about the other side of the Fed's mandate, inflation? Do you think they're concerned about what we're seeing right now out of the Middle East and the spike in oil prices?
I don't think so yet. Obviously, inflation is always a danger from energy, but energy prices have come down a lot, and they would have to go up a lot in a short period of time to have an impact on the CPI next month because we're already below where we were. Oil prices have been going down for 6 months. So it's not a real danger at this point. And gasoline prices have reacted very slowly to oil prices, but they have been coming down at a retail basis very regularly. So it's not even clear that Americans would see a change at the pump that would cause their moods, either their confidence to spend or their desire to vote for somebody by the time the election comes around.
So maybe that's not an inflationary risk to the Fed right now, but we have heard Fed speakers, Austin Goolsbee, talking about the port strikes and the potential risk there. At what point does it stretch on long enough that it becomes a macro issue for the American economy and the Fed needs to pay attention and recalibrate?
Well, it's hard to say exactly, but after a couple of weeks, you'll see some segments of the economy start to see shortages, which will drive up prices. We've joked about how bananas are going to get hit right away because 75% come in through the ports. But it depends on how much it affects people's jobs and inflation. And inflation is probably going to be sticky in this case, slow to rise, because companies are going to be looking through this as well. And they don't want to make people angry, customers angry. The question is, are we going to see companies relying on inputs have to close down production because they can't get the materials to keep making this stuff that they're making?
Bananas aren't a joke, Mike, just to be very clear, because they will rot, and that is the main source.
We have bananas upstairs. You can go grab a handful for the rest of the week.
This is the problem, that they rot, and you don't want them rotting at your desk. That's a problem.
Them.
I mean, okay, well, we can discuss the freezing. Michael McKee, thank you so much, and keep in mind, bananas are important. Coming up tomorrow, Jared Woodard of Bank of America, Adam Posen of the Peterson Institute, who will tell us all about the other side of the risk, the inflation side of the risk, and Lindsay Piegza of Stifel. Jack Manley of JP Morgan also going to be joining us. Today, we're parsing through a number of different risks, a number of different possibilities. It seems like up front, people are wondering about the jobs data that we got yesterday in terms of jolts and the underpinning of quits and how much that's going to affect things. You've got the geopolitics of it. And then you have just sort of this uncertainty, this overhang of what is going to happen with the election and just how much could policy potentially shift. Danny, what do you have your mind on right now, other than the seagulls at the ports and potentially what that could mean if that does carry on?
That is certainly still in my mind, but I just come back to what we keep experiencing over the past 2 months, that every month starts with not this specific risk that we're dealing with now, but some sort of risk, and the ability of the market to look through it, that it can say, look, the Fed is cutting, China's issuing the stimulus, why not buy? And maybe why not buy not just the US, but China, EM, all the risk assets look so attractive right now. And the market has been remarkable at just looking through the headwinds.
It's got to be the geopolitics. We're waiting for Israel to respond. Will that be today? Will that be in a few weeks? And as you said, so many clouds overhanging this election.
Although a lot of people don't seem to be trading on them, as we heard earlier in this hour. Right now in markets, though, you do see a soggier feel, even with better than expected ADP report, although coming back a bit. S&P futures now down just about 0.1%. A little bit of dollar strength across the board, and you are seeing yields actually markedly higher, particularly on the long end, up 7 basis points. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What would you say somebody young who's watching this should do if he or she aspires to be like you?
There's one component of our industry that people need to focus on, and it's not technical, and that's communication skills. Focus on being a phenomenal communicator, invest in that. Think about it, we have to convince a company to sell to us. You just don't walk in and buy the stock or tell them, yeah, you're for sale, I'll pay you this price. That takes years of relationship and effort. Why would somebody sell you that billion-dollar software company growing at 20%? Just because? No way. People hang on to these great assets. And then how do you get on the same page with the executive team of that company, even if they're existing or new? It requires just amazing communication.
If you go to a cocktail party and somebody comes up to you and says, I have $100,000 I'd like to invest, what do you would recommend that person do with $100,000? What do you think is a good idea to do with $100,000 today?
Sometimes they do, and I give them the most boring answer ever, S&P 500.
Just buy an index.
Buy the index. You don't have to worry about the quarterly earnings of a company. Did something change? Did somebody change management? You don't have to make this your full-time job. Just buy the index and you're going to be okay.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Futures still under pressure coming off of yesterday's wipeout. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, wait and see mode. Investors assess the escalating crisis in the Middle East as well as fresh data ahead of Friday's much anticipated jobs report. Also, Nike's reset, shares falling as the sportswear giant withdraws its guidance after sales missed estimates. Plus, an exclusive conversation with Emmanuel Macron. The French president speaks to Bloomberg about Europe's evolving role in a multipolar world. All that and more coming up, but let's take a look at where markets are trading 30 minutes until the bells ring. You can see the S&P 500 under pressure pre-market. Of course, we got stronger than expected ADP just a little while ago. Not really making much of a dent, of course. Still anxiety out there about what's going on in the Middle East. We'll get to that, but you can see that reflected in the NASDAQ 100 as well. Currently down about 0.1% on your big tech index. Meanwhile, you're not seeing a haven bid in the bond market. That's interesting. You take a look at the 10-year Treasury yield, reversing some of the gains that we saw yesterday. Yields currently up almost 7 basis points, Shonali.
Let's take a look under the hood here. Some of the stocks to watch, as you've been talking about, Nike withdrew its full-year guidance in an effort to reset expectations. That's as Elliott Hill prepares to take over as CEO. You have Nike shares still down, though, more than 7% pre-market. I'm also watching shares of Humana just plunging after seeing a significant drop in membership enrollment for its Medicare Advantage program. This drop in Humana of more than 20% pre-market could be the worst you've seen in more than a dozen years. We'll keep an eye on that throughout the show as well. LPL Financial had abruptly fired its CEO, Dan Arnold, for violating the firm's code of conduct to maintain a respectful workplace. And it's deeming him ineligible for severance. Yet remember, Dan Arnold, you had the stock rise every year since he's taken over, now operating with an interim CM. You have LPL down almost 3% pre-market, Katie.
All right, let's also take a look at shares of some Chinese-listed stocks surging on growing optimism over the government's stimulus plan. You have China stocks outperforming their global peers in recent weeks. We aren't necessarily getting new news when it comes to Chinese stimulus. Of course, mainland China currently shut for a holiday, but you did have Chinese shares listed in Hong Kong really surge last night. And I don't know, Shonali, when it comes to this big rally that we're seeing in China, I wonder how much you can really trust it. We've been here before. Think about 2022, for example, that reopening that was the consensus trade. It didn't work out too well.
You've been asking so much about the spillover into U.S. equities. Well, maybe here's one. We have Tesla deliveries now coming in at 462, almost 463,000. The estimate was just about that. It is slightly lower than estimates, but you do have an increase relative to what we have seen from Tesla prior in the year. Actually, let's bring in Bloomberg's Ed Ludlow now, because China is a large part of that story. How are investors going to digest this?
Well, the stock's fallen to pre-market session lows. Overall, the third quarter numbers miss street expectations. It's always important to emphasize that it is consensus or the average of sell-side estimates. You should break down the data in as far as you can. So if you look at 3 and Y, which is the only model line that they specifically break out, deliveries were about 440,000 above estimates, but it was kind of that other bucket that came in weaker. And you're right to point to China, because there was hope that China would be a bright spot here. There have been government subsidies, basically a trade-in policy, where the China-specific data, the government or third-party data, did show some strength. So the market's punishing Tesla a bit for missing sell-side estimates, but as you guys know, this is a name where the business of delivering cars to consumers is kind of in the rearview mirror, and the future's about a very different business model.
Yeah, you're right there, Ed. Tesla shares currently down about 2.5% pre-market. Of course, after those deliveries, those third quarter deliveries, missed estimates a little bit. And I'm hoping you can disentangle for us how much of this, of course, disappointment is Tesla specific versus industry specific, because we hear all the time about EV demand not being as robust as a lot of these automakers had expected.
Yeah, I mean, I'm looking at the stock. We're down now 2.7%, 2.6% in the pre-market. I guess the expectations are high in the sense that consumer sentiment may have adjusted to electric vehicles, in the sense that higher rates in a higher rate environment were putting consumers off. Now, we've had slightly incremental moves lower by central banks around the world. That isn't going to suddenly send consumers flying to lease or finance new vehicles, but it can always have a psychological effect. You have to look into specific markets, I mean, and take delivery numbers in aggregate. In Tesla's case, it's funny because, again, I reiterate the breakdown of the data insofar as we've got it. 3 and Y in that basket of the higher volume selling cars beat estimates. Everything else, which is XS, Cybertruck, which is a strange one, maybe we can chat about, and then Semi missed estimates. Usually you wouldn't linger on that latter bucket. Maybe hopes are really high for Cybertruck, which you see a lot more of on the roads at the moment in North America.
All right, Ed, really appreciate that. Of course, Tesla shares still under pressure, currently down about 2.5%. Of course, third quarter deliveries coming in a little bit lighter than expected. You can catch Ed on Bloomberg Technology right after this show, but let's stick here and let's pivot to politics, because last night, J.D. Vance and Tim Walz made their pitch to American voters at what is likely the last debate of the presidential election. Here are just some of the takeaways, starting with the geopolitical tensions that the next administration will inherit.
When our allies see Donald Trump turn towards Vladimir Putin, turn towards North Korea, when we start to see that type of fickleness around holding the coalitions together, we will stay committed. And as the vice president said today we will protect our forces and our allied forces, and there will be consequences.
As much as Governor Walz just accused Donald Trump of being an agent of chaos, Donald Trump actually delivered stability in the world, and he did it by establishing effective deterrence. One thing that Joe Biden did is he continued some of the Trump tariffs that protected American manufacturing jobs. And it's the one issue, the most pro-worker part of the Biden administration, it's the one issue where Kamala Harris has run away from Joe Biden's record plan, but it's also a record. A lot of those same economists attack Donald Trump's plans, and they have PhDs, but they don't have common sense, and they don't have wisdom.
Well, Kamala Harris's day one was Donald Trump's failure on COVID that led to the collapse of our economy. We were already before COVID in a manufacturing recession, but 10 million people out of work, largest percentage since the Great Depression.
Let's now get the download with Bloomberg's Michael Shepard, who is a senior editor for us in Washington, D.C. Now, we know both candidates had grappled to address two major issues, and that's the toll of Hurricane Helene, which also happens to be in key swing states, as well as the Iranian missile attack on Israel. Should the candidates have gone further in speaking to the U.S. response?
Well, you know, the way the questions were framed was on Helene around climate change. And this is one that Tim Walz was able to take and seize on and point to the Harris-Biden agenda, pointing to the Inflation Reduction Act. We were just talking with Ed Ludlow about electric vehicles, all the subsidies under that law aimed at encouraging Americans to transition over to electric power vehicles to reduce emissions. J.D. Vance, for his part, seized on the question in a different way, and he used it to fault Harris for failures in terms of failing to promote manufacturing and allowing China to gain ground in certain areas, including electric vehicle technology. At the same time, on Iran, we heard in the clip, when they were asked about it, Tim Walz used the moment to really frame the argument against Donald Trump, to once again say, continuing the Harris line, that the former president is unfit for another term and is not suited to lead the nation. And then J.D. Vance, as he took the question, he tried to point to Donald Trump as the most effective agent of deterrence the White House has had.
All right, Bloomberg's Mike Shepard in D.C. We appreciate your reporting. Let's broaden out this conversation now, because here at the desk we have Tony DeSpirito. He is BlackRock's global CIO of fundamental equities. It's great to see you again, Tony.
Great to be here.
So in addition to politics, of course, in addition to the economic data that we're getting, you, of course, have what's unfolding right now in the Middle East, those geopolitical tensions. And I know that you preach the power of compounding, staying investing. And with that in mind, how are you viewing, of course, geopolitical tensions? Do you hedge that, or do you look through it?
Sure. There's a short-term lens and a long-term lens. And if you think about the long-term lens, I mean, look over the last 50 years, the events we've gone through, you know, a president resigning, stagflation, the 1987 stock market crash, the three Gulf wars in the Middle East, the global financial crisis, COVID, right? That's a long list of things to worry about. S&P, if you took $5,000 and invested it 50 years ago, you'd have $1.3 million today. So that's the power of compounding that we spoke about. In terms of what's going on today, I mean, certainly in the portfolio I run, the equity dividend fund, for example, we have overweights in defense stocks and in energy. And I think they're good investments in and of themselves, good free cash flow, good yield, et cetera. But they also, in times like these, help provide some resiliency to the portfolio. And so I think that's an important short-term hedge, if you will.
I want to also kind of broaden out to what's going out here in the United States as well, because, of course, you have a lot of tension in the Middle East. It did weigh on stocks, at least in the near term here yesterday into this morning. But you also had that ADP data that came in stronger than expected. So the American economy is holding up. You had yields rise marginally on the heels of that news. What does it mean if you still have the strong economic data and perhaps the Fed is not able to cut as much as expected? If oil prices, because of the geopolitical tension, stay higher than expected and those cuts just don't materialize because of the strong economy and potential inflation?
So I think we're at a really nice point in the cycle. If you look at the ADP number, 143,000 jobs, that's a very sustainable number. So if we continue at this pace, I think that's great news for the economy. Not too hot, not too cold. And I think the fundamentals in terms of the economy, in terms of company earnings, that matters a lot more than rates do.
Well, let's talk a little bit more about rates. It is interesting, of course, and striking to see the Fed cutting into strength and expected strength. We haven't really seen that before. There's not a lot of blueprints for that. So what playbook are you following here? Are you writing a new one for this Fed cutting cycle?
Well, one of the nice things about this cycle is the rate cuts aren't driven by fears of the economy going into recession. It's driven by the fact that the Fed has the luxury of cutting because inflation has come down quite nicely. And so we're seeing inflation very much at or very close to normalized levels that the Fed wants to see. And so I think about it as the Fed has a lot of stored power, right? Rates were 5.25%. They can bring them down pretty dramatically and keep this economy going. And so I think what we're seeing is kind of just normal mid-cycle activity. Now, normally in a rate cut, the factors and the sectors that work well, it's factor-wise, it's low beta stocks, high quality, large caps over small caps. Sector-wise, healthcare, staples tend to do very well. I think that's still a good playbook because when I look at the valuations of those sectors and those factors, they all look pretty good to me. And history tells you they have a high hit rate of working.
Tony, in the near term also, we still have, with the election, potential regulatory risk in certain sectors. I was really interested last night to hear healthcare come up as much as it had. That seems to be a bipartisan issue, the cost of healthcare. How do you really invest across the healthcare sector when there's that much risk in terms of pricing for Americans of ordinary drugs?
Yeah, so I actually think there's less risk this election than in prior ones. I mean, if you look at the presidential debate, there was very little talk about healthcare, actually. And so I think that's pretty good. In terms of when I look at kind of the elections and how they impact markets, typically not a lot of impact on the overall market. And obviously certain sectors more so, but in terms of the overall market, who wins doesn't really impact the long-term results of the market. One of the other interesting things we've seen in studying elections is often the initial reaction is the wrong reaction. Meaning if you look at the last 7 elections, 5 out of the last 7, if you take the results of the first month in terms of factors or sectors, over the next 11, they completely reversed. And I think that's the interesting result, is that people tend to think, oh, there's going to be big policy change. The reality, never so much.
Yeah, and I think we all have painful memories of 2016, of course. You had the knee-jerk reaction, and then it completely reversed. I do want to get your thoughts on China, though. We were talking about this a little bit at the top, that obviously you've seen euphoria just unleashed in the Chinese market right now. Of course, the CSI 300 now in a bull market, even though, you know, we were nursing losses just about a week or 2 ago. How are you thinking about China? How can you be sure that this is a sustainable, real rally that might actually have positive implications for the U.S. versus just another head fake?
Yeah, so as you know at BlackRock, or may know, we have a tactical overweight on China. And I think it's a matter of there are some long-term structural issues. But on the other hand, we do have a big amount of fiscal and monetary stimulus that just came out. And I think when you look at what happened in the market, it's really reflective of the fact that the starting point, the valuations were so low. So there was a really big gap, you know, near record gap between developed market valuations and valuations in China. And you know, valuation, I like to say, is never tells you when something's going to start to outperform, but it certainly tells you the magnitude or the potential magnitude of how much something can outperform. And I think that's what we've really seen, is just valuations coming off of really depressed levels.
All right, Tony, you're sticking with us. We're going to get into the nitty-gritty of U.S. earnings next. That is BlackRock's Tony DeSpirito. Let's quickly check back in on Tesla, though. Of course, getting those third-quarter delivery numbers coming in a bit light overall. You can see that pressure reflected in Tesla pre-market right now, currently down by more than 3% right now. You take a look at what did well. It was Model 3. It was Model Y deliveries coming in a little bit heavier than expected, but other model deliveries coming up short. Meanwhile, we're going to take a look at what else is not doing too hot this morning. Nike withdrawing its full-year guidance as it prepares for new leadership. We'll take a look at the state of the swoosh next. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because you know, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics of the math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back to Bloomberg Open Interest. Let's take a look at how markets are faring before the bell, and there is red on this screen. You can see the S&P 500 down about 0.2%. It's a similar story if you take a look at big tech in the NASDAQ 100. Of course, those geopolitical fears still weighing over markets after what we saw in yesterday's session. We got hotter than expected ADP this morning. That's having quite a reaction in the bond market, not so much in stocks right now, as you can see, holding those losses. And the Russell 2000, your small caps, currently off about 0.6%, Sonali.
And we're going to bring back Tony DeSpirito, BlackRock Global CIO of Fundamental Equities. We've been talking about sectors before the break as well, and I want to go right to the consumer sector, because if employment seems to be holding up, we're waiting that all-important jobs data still, but the ADP was promising. You had that bid since the Fed rate cut into that consumer discretionary sector, but you're seeing a ton of divergence here. How do you think about the strength of the U.S. consumer in terms of how you invest in equities today?
Yeah, so a couple of things. One is when you look at sectors, I always look at dispersion within a sector, right? And consumer discretionary, it's not the highest, but it's towards the high end in terms of dispersion. And to your point, each company is very different. An auto manufacturer is very different from a consumer retailer, for example. The other thing that we see is certainly, high-end versus low-end consumer, a real disparity there. And the low end, has been struggling, right? Got a big boost during COVID, has worked off those COVID savings, and now is struggling. And so we definitely see that and look out for that. And then the other thing I would say is, it's a matter of earnings. And so as long as jobs stay strong, unemployment low, the consumer will continue to spend. And then we got some nice data revisions, right, in terms of personal savings rate, right? It had looked like it was extremely low. Based on the revisions, that's much more into the normal range now. So that gives me a lot more comfort when it comes to consumer spending. That good jobs, interest rates coming down, I think the consumer is still in good shape.
Well, you talk about revisions. It's going to be interesting to see what we get on Friday. Of course, those jobs numbers have been steadily revised down over the past several months. But I want to stick on earnings, and I want to talk about how you're viewing the market in terms of market cap tiers right now. There was an interesting note from Torsten Slok of Apollo earlier this week saying that 42% of companies in the Russell 2000 have negative earnings. Then you do that analysis over the S&P 500, it's just 6%. So when you're taking a look at earnings and you're applying it to this small cap rotation that people keep talking about, how choosy do you have to be?
So people keep asking about that small cap rotation, and I go right to the number you cited, that over 40% of the companies in the Russell 2000 index are unprofitable. And even then, when you exclude those companies, it still has a higher PE ratio than the S&P 500. What I think is the more interesting question is mega cap versus run-of-the-mill large cap. So if you look at the S&P 500, the weighted average market cap is actually pretty close to $1 trillion. And it's really driven by 6 companies. We have a couple of companies at $3 trillion, 6 at about $1 trillion or above. Once you exclude those 6, the weighted average market cap goes from nearly $1 trillion down to about $250 billion. Wow, that's a big difference, right? And when I think about it, a company with a $150 billion or $250 billion market cap, it's a lot easier, just the law of large numbers, it's a lot easier for that company to double in stock price than it is for a $3 trillion company. And so we've been calling for a broadening of the market for a while now. And one of the things that we saw in the third quarter was, indeed, we got a broadening of the market where the equal-weighted index outperformed the cap-weighted index. And that hadn't happened in a while. Over the long run, actually, the equally weighted index wins. and it's trading at a 25% discount to the cap-weighted S&P 500.
There's another part of the consumer sector I kind of want to tangentially hinge on here, and that's housing. The reason is I took a look while we were talking on what the best performing consumer discretionary stock is. It's Mohawk Industries, of all things. Lululemon, Nike, all much lower on the year, but this is a company, Mohawk, that focuses on ceramics and tiling. And you see that consumer bid really come into the housing sector, but you're not seeing people buy houses yet. At what point does that become a trade that you like because you finally see activity really loosening up this market?
Yeah, so what I think is really the stored potential in the housing market is housing turnover. If you look at housing starts, they're a little depressed versus long-term history, but what's really depressed is turnover. And there are various ways to play that. One of the ways I like to play it is through title insurance, right? When you get a mortgage, you have to get title insurance. When you refi,
really
you get
hot
title
names
insurance.
over there, Tony.
Certainly very niche-y, but really interesting because it really benefits from turnover. And you don't care about housing prices. You don't care about margins on housing products. You just care about turnover. And that is the factor today that's most depressed. We need rates to come down a little bit more, and I think you'll really see an acceleration in the housing market.
All right, well, plenty of people say that's in the offing, so we'll have to keep a look at title insurance. Tony DeSpirito, it is great to see you. That, of course, is BlackRock's global CIO of fundamental equities. Meanwhile, let's take a look at Nike. The stock falling pre-market after the company missed on sales estimates. It withdrew its full-year sales guidance. This all coming ahead of new CEO Elliott Hill's arrival, giving him a clean slate. Here with more is Bloomberg's Kim Bastine, who, of course, covers the company. Okay, Kim, so they withdrew full-year guidance. They postponed their investor day. That's not necessarily surprising, and yet you see shares down by more than 7.5% pre-market. How do you explain this reaction?
What they're doing here is really resetting expectations for this incoming CEO, Elliott Hill. So he starts on October 14th, and right now they're in this transitional period in between. Like on that call with analysts for earnings, it was the CFO, Matt Friend, who was the only Nike executive addressing investors and analysts. John Donahoe, the previous CEO, wasn't even there, and they're just waiting for Elliott Hill to begin his tenure.
No, it's interesting, Kim. I was reading a note earlier today from Ashwat Damodaran, who is the Dean of Valuation, really, at NYU, very famous for that. He said at $71 a share, the stock price was in your favor for investing odds, and that boost in the stock price that went past $88 had really suggested the expectation for higher growth and better margins. How much pressure is on the new CEO to deliver that, given that the bounce has already been seen in the stock, frankly?
A lot of pressure, and at this point, this is the starting point for his turnaround, right? So this past quarter, analysts were saying they didn't really care about, it was so backwards looking because the status quo has changed so much since then. So what they're waiting for now is the new CEO's plan. They had planned an investor day in November, but they've now pushed that back to an unknown time as he prepares that turnaround strategy. So a few months from now, we'll find out.
Less than a minute here, but really quickly, I mean, we don't know the plan yet for Elliott Hill, but have to imagine it'll be reconnecting with retailers.
Yeah, so Nike went through this retail pullback from its retail partners in favor of its own stores and website. It was a direct-to-consumer strategy that seemed to go a little too far. So they're reconnecting with retailers like Foot Locker and rebuilding those relationships that they really set aside. There's also rebuilding relationships with employees who were having who had a lot of issues with their former CEO.
All right, Kim, great reporting as always on all things Nike. Our thanks to Bloomberg's Kim Bastine. Of course, Nike shares down 7.5% pre-market, down about 17% year to date. Meanwhile, we brought now to the broader market right now. Of course, 4 minutes before those opening bells ring, you can see the broader market is under pressure as well. The S&P 500, the NASDAQ 100 currently off by about 0.2%. The Russell 2000, your small caps, down 0.5%. We'll have all the coverage of the market open coming up next. This is Bloomberg.
we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in LIV, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of a year and a half, basically, we've pulled that 67 and a half down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with. Right? So all of a sudden, we're seeing these data points coming out going, my gosh, why haven't, we're owning this space.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
All right, we are moments away from the start of trading, of course, on the second trading day of October, the second trading day of the fourth quarter. 18 seconds to go. This is Bloomberg Open Interest. I'm Katie Greifeld, and of course, following through on what we saw yesterday, of course, that geopolitical tension making itself known in the U.S. equity market, still under pressure this morning. And the question becomes whether or not this episode will be inflationary. Of course, you've seen the follow through in oil. You're seeing that in the energy names as well. And you were seeing it in the bond market, of course, that haven bid now reversing after that stronger than expected ADP print that we got at 8:30 a.m. Let's take a look at where the major averages are trading. Of course, just a couple seconds into the trading day, you can see the S&P 500, the NASDAQ 100, your big tech stocks, both under pressure this morning on those indexes, down about 0.2 to 0.3%. It's the small caps that are your biggest losers so far today, down 0.3%. We'll see what happens between now and 4 p.m. Of course, maybe those dip buyers come in, but some stocks to keep an eye on under the surface. You have Nike trying to wipe the slate clean for incoming CEO Elliott Hill, pulling its full year sales guidance yesterday. Of course, also announcing that it's postponing its investor day set for November. You can see shares still down about 7.5%, Shanali.
Also watching some more red tape. When you look at Humana, it reported a significant drop in membership enrollment for its Medicare Advantage program. It could impact revenue. Humana shares at the open down more than 21%. This could be the biggest drop in years. We'll keep an eye on it. Also watching shares of Tesla, shares down after the EV maker's third quarter deliveries, slightly behind the average analyst estimate. You have Tesla shares down almost 5% at the open, Katie.
All right, let's pull back here and take a look at the broader markets. The reaction that we've seen, of course, to those geopolitical fears flaring up again. Bloomberg's Jess Menton joining us now. And Jess, it's striking. I mean, you think about past episodes of escalation, you didn't necessarily see it make a dent in the U.S. Risk asset market, but still today and yesterday, you saw it.
And especially because and you were just alluding to this, because it is the second trading day of the fourth quarter, and we just came off of the best first 9 months to a year since 1997, and the S&P 500 was already up around 20%. So when you have the S&P 500 trading around all-time highs, and then you have things like this happen, and especially when it's trading close to that 50-day moving average, a little bit of weakness there. And then especially with the VIX, I did a taking stock column this morning that looked at kind of what typically, because I think a lot of times October, a lot of people think it's a spooky month when you think about the stock market crashes of 1929 or 1987 or 2008, but it's not the worst month of the year. We know that that's actually September, followed by August. It's actually the most volatile. Exactly, not this year though, and it bucked the trend in September, and it was up about 2% last month. So actually, October is the most volatile month of the year by far, and it's about 34% higher when it comes to that volatility compared to other months.
I also want to bring in now what the sectors look like under the surface. Katie, almost every sector here is in the red this morning. There's one sector in the green, and that's energy. It's up by more than 1%, not surprising. Second day of gains here in Brent prices, New York crude. You are waiting, the market is awaiting to see what Israel's response will be to that Iranian ballistic missile attack. At the end of the day, with energy higher, what is the risk for stocks? The first thing you think about is inflation.
Exactly, but the Fed obviously has made it clear that they're more focused on the other side of their dual mandate when it comes to employment. And a lot of times when we've seen geopolitical conflicts, especially in the Middle East, a lot of times when you think about the energy producers in the U.S., for instance, yesterday when we saw that spike higher with crude prices, you saw companies like Exxon and Chevron and other big oil producers moving higher because a lot of times in Europe, they're more dependent, and it's a little bit different when you think about how we're set up here in the U.S. So typically, you might see a particular spike there when it happens, but I don't think the Federal Reserve would be as concerned because it's still, we don't know how exactly all this is going to play out. And especially when you're looking at the options market, they're still more concerned right now about when it comes to employment reports like on Friday versus, say, the CPI report later this month.
Yeah, it's a fair point there. And you think about what the Fed pays attention to, those core figures, for example. Energy, of course, doesn't factor in. But I am curious, you see energy up partly because people are hedging right now. That is their preferred way of hedging. And I'm curious, when you're talking to investors, to analysts about these risks that are out there, how are they choosing to hedge? Is it in the options market? Is it buying energy stocks? Is it going into the bond market right now?
Well, even if you look at the put-call ratio from SAPO, right now, even coming into this week, it was actually pretty low and a lot lower than you would expect if you're looking at the 5-day moving average right now. So coming into this week, if you're looking at how hedging was compared to the SPY, obviously the ETF that tracks the S&P 500, it wasn't as pricey as you would probably think it would be. So right now that tells you they're still not necessarily thinking that there are major risks. But of course, we still have a blitz of earnings season that are going to come October 11th. We'll have JP Morgan and the other banks reporting. You still have the election coming up on November 5th. And obviously 2 days later, you'll have the Federal Reserve decision. But right now, when you're looking at as far as what hedging is, it's not telling you that there's that much concern. Right?
One more on inflation. I totally hear you guys on the energy point here, but you do still have a market that is pricing in at least 100 basis points worth of rate cuts through the beginning of January, at least, or the end of January, rather, right? So it's still significant. If you don't see those materialize to that degree, what does it mean for the stock market?
Well, when I've been speaking with portfolio managers, a lot of times, especially when you're talking about swaps, if there is more of that indication that they're leaning more towards 50 in the swaps market, but then even if you're thinking about central bankers, depending on if they're signaling maybe it might not be 50, just depends on what the data says, then you'd have to see that type of repricing because if you think about the last meeting, obviously the swaps market was pricing in 50 basis points and the Federal Reserve did that. You saw stocks bounce off of that. So it might be a little bit of a different play there depending on whether or not you see how that shakes out. But obviously it really depends on the data that comes out in the next few weeks.
And if you are trying to trace the indirect route where these energy price spikes that we're seeing factor into the Federal Reserve's decision making, it matters for inflation expectations. You're seeing break-evens rise right now. The Federal Reserve absolutely cares about that. But let's look under the hood here because, of course, at the index level, we're down a little bit this morning. Tell us about what's going on with Apple, for example, and when we take a look at those individual names.
Right, so looking under the hood for Apple, it's actually down close to 1% right now. So you did see JP Morgan join Barclays as well as Citi as far as when it was downgrading a little bit of its outlook for when it was thinking about its iPhone unit sales. So it was coming in right now around 126 million units. It previously was 130 units compared to what they had that estimates prior. But also that stock's been up around 17% coming into today and for the year. And also it really had a first tough quarter that I think a lot of people forgot about, especially relative to the S&P 500, but it bottomed back in April and has been on a tear ever since. So when you see it pull back a little bit like that, it kind of makes sense to some technicians that I've been speaking with.
When we look under the hood, guys, today, there's kind of a lot of red on the screen and individual movers. We've been talking a lot about the single stock volatility. I also want to bring you to ConAgra here because you do see it down roughly 7% as the market opens, more than that now. What are the issues?
Right, so this is especially a key space when you're thinking about consumer packaged good companies and what that means for price to mix, because Jen Partashis over at Bloomberg Intelligence has talked a lot about these types of companies because right now their fiscal first quarter, their profit and sales outlook wasn't as strong as investors were anticipating. And a lot of these companies have had that margin pain just because they continue to have to pass on a lot of those costs due to inflation. And then once again, it did blame those types of inflation issues too. So when you're looking at that, and also not even just Conagra, but if you're looking over at what's happening with other companies that are in the consumer packaged goods space in the S&P 500, that index is actually down a little bit more than 1%. So obviously not just Conagra, but other consumer packaged good companies falling on the back of this report as well.
And we're watching that, of course, materialize, that drop that you're speaking about. Tell me about Home Depot, of course, today. Some sell-side action going on and potentially weighing on the stock here a little bit.
And you know, right now, you're seeing it down about 0.6%, but actually it was upgraded to a buy rating at Gordon Haskett. So they actually see potential improvement here in the home improvement type space, just on the back of where we're just talking about the Federal Reserve cutting rates, what that could mean for the mortgage space. But it's been interesting when you think about Home Depot as well as Lowe's, because they are a little bit of a different story. Usually Lowe's is more of kind of a DIY type of project type thing. We saw a lot of that during the depths of the pandemic. But when it comes to Home Depot, and especially with those types of stocks, a lot of that also has been just because those two companies are in the discretionary space. And those two, like discretionary as well as tech, were hit the hardest yesterday because they're more of the growth kind of corners of the market. So I think that's more of kind of it's being kind of holding back those gains, even though it had more of an optimistic rating here.
Yeah, it's a great point. Of course, Home Depot up mightily year to date, but a lot of question marks that are forming over the discretionary space. Jess Menton, it's always great to see you. That is Bloomberg's Jess Menton. Meanwhile, let's take a look at these broader markets right now, still under pressure, actually deepening losses right now. If you take a look at the S&P 500, at the NASDAQ 100, both down about 0.4%. Not really many bright spots to find in this market, especially if you take a look at the Russell 2000. That was your biggest loser on the day, but still off about 0.3%. Mild outperformance if you want to be optimistic, Shonali.
We were talking about most sectors in the red, but I also want to talk about some individual stocks, particularly Humana. The drop is the most since you've seen since February of 2009 at more than 22% lower at the open. There are worries building about Medicare revenue on top of previous worries about costs and tighter reimbursements. We'll keep an eye on that as the day goes. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
As we spent
on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning.
I think this event. Look, I hope the maximum number of items, because I really believe that we are at risk, to be honest. And it's just a word. I think our own model was completely changed and has to be reset. And when you look at the European model, largely based, by the way, on the strengths of Germany during the past decade, we were based on exports and a big part of the key industry, car making industry, to China. We were based on low-cost energy, Russian gas. We were based on defense umbrella from the US, without any question. And everything now is shaken. China has overcapacities and is clearly a competitive place. So it's no more a secured place for our exports. Russian war killed low-cost energy, and the killer of our competitiveness today is a big gap in terms of energy prices everywhere. This is why we have to completely change our business and have an integrated energy model, because we can deliver with nuclear and renewables, but not without being integrated. And very clearly, post Afghanistan, some people are going to have doubt, and the potential change in leadership in the US means that this is not a guarantee total. So I want to insist on that, because it's super important to assess fairly the fact that our former model is over. And this is not a question of adjustment. This is not the same world, 2024, 2025. And on top of that, we are making the same mistakes on top of the key elements I mentioned. We are over-regulating and under-investing. So just if in the 2 to 3 years to come, if we follow our classical agenda, we will be out of the market, I have no doubt. So I think what we have to deliver in the 2 to 3 years to come is capital market union. My view is that we have to rush on energy beyond what we already decided, which will be implemented for 2026, which will avoid the big peak and the instability of the energy market we had during the past few years. We corrected that, but we have to go much faster and further. And we need this investment shock I mentioned. And I think the simplification agenda and let's say, pause in terms of regulation, but even deregulation in some issues, it's absolutely critical.
Can you have any investment, can you have that investment shock without issuance of joint debt?
I think, the best way to deliver is not to create big trauma at the beginning, by experience.
But you persuaded the Germans before, can't you do it again? This
is true, but I was... if I want to be fair, I was a little bit helped by a colleague called COVID-19, and it changed the reality. But what I think we have an external systemic shock. I think we have to assess that. During the pandemic, we all experienced a symmetric shock for all our economies. And this is why we made this move with Chancellor Merkel. And I think it was a unique move, and this is really, for me, a fundamental change of our EU. Now, I want us to be totally aware of the fact that we are living a symmetric shock on our economies whose scale and magnitude is underestimated. Because the reallocation factor is huge. Look at the chemical industry in Europe, completely being relocated because of IRA, I mentioned. If you don't deliver the level playing field agenda, we will be super happy with REACH as a good regulation for European consumer. But for no more existing chemical industry. And it will be the same for steel, it will be the same for I mean, the existing business we have because of energy costs and over-regulation. So we have to fix energy issue and over-regulation. And for me, single market on energy, and on top of that, diversification of our furnishers to reduce this discrepancy, and acceleration of level playing field agenda and pause in terms of regulation. It's critical. And if we don't have the level playing field agenda, we will be killed in this market. And in parallel, for clean energy and artificial intelligence, we have to invest much more rapidly and protect as well our key players. Otherwise, they will be reallocated in the US.
Lars Henrik, I mentioned the joint debt question, but actually there's a broader issue here that you listen to President Macron, you read the Draghi report, you read many speeches, frankly, from European leaders, but not from the German Chancellor, not from German leaders, assessing the threat to the growth model as fundamentally as this, the stark language that President Macron has used. If looking on the outside, how does Europe move forward, rush forward on this agenda if there isn't that understanding, that same analysis at the top in Germany?
I'm not sure that you don't share the analysis with the Chancellor Scholz. Obviously, he's a different person. But I think the analysis that we need simplification, what you were just saying, we need more investment, we have less regulation. I think that is something which, the Chancellor also says. I think that's a fundamental issue. I think capital market union, as I said, is an important step. But in the end, and he has been a remarkable European. I remember when you first came, you're actually the Sherpa for a while, if I may say that.
You were both Sherpas together, right?
Yeah, but he has moved on a lot since then.
I don't think you should feel bad. I think it's okay.
And of course, he's there's a reason why he's moved on, and so he came on stage and he said, "We want Europe," and you give your speech, and there was a debate whether Germany was responding appropriate to the young French president who was doing that, But I think he was always this good European, and I think we're very lucky to have him actually as a European. Also, if you think about the latest developments in your country, if I may say so, Mr. President, and also in our country. And I think the ultimate problem always in the end, and you alluded to that in the previous round on AI, the Justerie 2 or the European industrial policy, is that there's still no European answer to many of these things. And if, in industrial policy and deregulation, and Draghi report makes that point. And is Europe really ready to give more power? You always also talked a lot about the governance of Europe and, the way we are organized with Commission and Council and very powerful national leaders. And that is a fundamental issue, which I think makes it very difficult. But I think this is something which, in the end, is going to be, again, a very important issue. So I think that is something which is... But I think that the Draghi reports on the common debt, this is where I was getting here. I think, if I may say that, and you're closer, of course, than I am, I don't think the problem is not the common debt per se, but I think is that you want to make sure that the money is spent properly and there's no moral hazard with it. We discussed this a long time, many times. So I think it requires also certain governance. For example, you think about the defense union. I think if you want common debt on the defense union, you also need competences at the European level.
Let's talk about more
because you have to have
the benefits of open source AI. So another thing you mentioned in your letter is that open source AI can accelerate innovation and economic growth. How is this already happening, and how do you see this happening more in the future?
Yeah, I mean, I think that there's a version of this which AI will do no matter how it's developed. And then there's a version of this that I think benefits from open source specifically. So I think that AI has more potential than any other single technology that's being developed right now to increase productivity, accelerate the economy, make it so that kind of every person has the ability to be more creative and and produce more interesting things. And I think that that's all going to be great. I also think, I hope that it'll help out with science and medical research and things like that. There are a lot of folks today, though, who don't necessarily have access to the ability to fine-tune or build their own state-of-the-art models. So they're sort of limited to what these large labs do. And like I just said, I think one of the defining aspects of our culture around innovation as a sort of a country or society is like, it's not just big companies that do it, right? There's all these startups and hackers and academics and people in university. And I think you want to give all of those folks access to state-of-the-art models that they can build on top of. Not just that they can run, which is what they have today with the closed vendors, but that they can build on top of and tweak and distill down to smaller models that they can run on their laptop or their phone or whatever other device they're building. And I think that that's just going to unlock a ton of progress. There's also a version of this where you can look at it by, nation too. So it's not just that startups might not have the resources or universities might not have the resources to go train their own, large-scale foundation models now or in the future. But there are a lot of countries that aren't going to have the ability to do that because, pretty soon these things are going to cost many billions of dollars to train. And I think that having the ability for different countries and entrepreneurs in different countries and businesses to use it to serve people better and just do better work is going to be something that basically like lifts all boats around the world and just has a massive kind of equalizing effect. So I think that that's really positive. And, that's one of the places where we get the most thanks for this is not actually the tech community, but it's like different developing countries or other countries that want to have access to the technology and do stuff with it. But wouldn't necessarily have the tech field themselves to produce something that is state of the art that their businesses can build on top of. But once they have it, it's actually pretty easy to go train your own thing. So that's a pretty neat part of this.
Chinese ones. So we created a dependency, which could create some problem. We experienced that in COVID time. And we killed the ability to produce on the European soil. It's not a good idea when you need growth and you have to finance such social model as the one we have. Now the question is, do we want a fair competition or not? I do want a fair competition. So the EU Commission launched precisely a series of studies, exchanged with all the car makers, and just correct the level of discrepancies to re-establish the level playing field. So you have something from 9 to 10 for those who are less helped, and I think the range is between 21 and 35% tariffs for these car makers, but with evidence and figures which were exchanged with the car makers and will be exchanged with the Chinese industry. We already have retaliation, by the way. I can speak with a clear view because it's on cognac. Nothing to deal with the cars. And I can tell you that cognac was never helped by the French government. So, which means this is a pure retaliation. But this is a matter of credibility for our market. And I insist on that. If you don't preserve the level playing field, just don't hope that you want to produce and preserve your industrial footprint in Europe.
You spoke to Chancellor Scholz earlier. Did you make progress? Unfortunately, you didn't even have any advisors in the room, and the reporters were unable. There's no chance of us finding out. So I promised I'd ask you.
I do respect all the positions and the sensitivity of the market. I think the question is, what will become the Chinese market for the car makers? My view is that it did change during the past few years, and it should not be underestimated. This market is not just a market open to our car makers. You can deploy through GVs, good operations, but this is much more competitive than it was a few years ago. Chinese car makers are super competitive, and sometimes better than we are, and this is a market in overcapacities. And if we don't protect, but just restore the condition of level playing field, we will be the adjustment zone of the overcapacities, because the US just put a 100% tax 100% tax undifferentiated. So let's wake up. We live in the same world. You cannot have China over-subsidizing. A lot of countries, even India and others, reacting to these subsidies. The US overreacting by 100% tariff, and Europe saying, you're welcome. I mean, it doesn't fly. Otherwise, we will be happy consumers of non-European producers. I can tell you, we will have an issue of growth in a few years' time.
We want to make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'll be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating. And then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast. That's where you'll find us. This is the Bloomberg Intelligence Program. Alex Steele and Paul Sweeney. Coming up, we're going to get the latest from the Middle East. Aaron David Miller, senior fellow at the Carnegie Endowment. He'll give us the latest thoughts on these escalating tensions in the Middle East. Mary Ann Bartles, chief investment strategist at Sanctuary Wealth, will give us her market outlook here. And Henrietta Trez, managing partner and director of economic policy at Vaded Partners. She's going to help us to recap the VP debate and kind of set up this campaign as we make the sprint to Election Day on November 5. Right now, let's kick off this whole thing with Mr. John Tucker.
All right, Paul, stocks are lower in the early going. You have 9 of the 11 major index groups in the S&P 500. They are down. Energy is in the lead as we see crude oil prices pop on the Mideast tensions. Brent up over 3%, up $2.34 a barrel, $75.90. And U.S. oil, West Texas, that is up about 3.5%, $72.24 barrel. Consumer discretionary right now, that's the worst performing group in the S&P 500, and that is home to Tesla. And Carmen's going to be along in just a sec to take a deeper dive into that. And Humana shares also, they are sinking for the biggest one-day drop in about 15 years. Among the data, private payrolls increasing 143,000 last month. That's the reading from the private payroll provider ADP. Better than expected, comes ahead of Friday's jobs report from the Labor Department. Right now, the S&P 500 16 points lower. That is down 0.2%. We're at 56.93. The Dow Jones Industrial Average 75 points lower. That is down 0.2%. The Nasdaq 100 right now 42 points lower. That is down 0.2%. Let me do yields for you. The 2-year, more policy reactive. That is up 4 basis points, 364. The 2-year, the 10-year yield is just about 8 basis points higher. That is at 3.8%. And this report being brought to you by Interactive Brokers Portfolio Analysts. Consolidate, analyze all your financial accounts on one powerful dashboard for free. Sign up for Portfolio Analyst at ibkr.com/freepa. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele has jetted back from Calgary this morning, Canada.
Who goes to Calgary for one day?
People who are like an energy geeks. So I think she went to an energy conference there. They have lots of oil in Calgary, I think, and get natural gas and stuff like that. So they go out there. It's like the Houston of Canada, I think. So anyway, she goes out there a lot, but she's back. She's here. She'll be in our studio in a couple minutes. But John Tucker's going to hang around in case we need any help along the way here. But we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. As John was reporting, just, kind of unchanged there in the index level there. Not much going on here. But let's see what's going on with some individual names in the marketplace this morning. Carmen Reinke joins us. She covers all the equity markets for Bloomberg News. Carmen, what are you looking at?
Yeah, so the first one I'm looking at this morning is Tesla, ticker TSLA. Shares are down about 5.2%. It's off the lows of the day, but still not looking super great. So the company reported a boost. So it reported. It reported.
Well, I saw they had like
vehicle sales.
Yeah, the kind of vehicle sales kind of came in line with expectations.
It did,
but
yeah.
maybe I think people just feel like this is a quarter they could have done even better, maybe.
Exactly. So this came in sort of short of what Wall Street was expecting. It is the first quarter of growth that they've posted in a while, but Wall Street or investors just really aren't having it. I think it's also important to note that Tesla shares had been on quite a tear, so they're up more than 35% since early August. So it could also just be, this was a good time to maybe be taking some off the table there.
I'm not a car geek, John. I know you're not necessarily. We're no Matt Millers here.
No,
We're not the crazy
Nobody's
people
at that level.
like Matt Millers. But don't they have to redesign the style at some point?
It looks exactly the same now as it did when they first rolled off.
I mean, it's a good-looking vehicle, but don't car companies every 5 years, 6 years kind of redesign?
Now, what's their big market? It's got to be China at this point, right?
Mm-hmm. Yeah, well, and they're still boosting, subsidies for electric cars in China.
Yeah, I just don't know what the, again, it comes back to the whole question, I think, global car industry is figuring out is, what's the demand for these things? I mean, I really don't know what the ultimate demand for EVs is. It appears like it's less than maybe we thought even 2 or 3 years ago, but this is just a bump in the road as we build out the charging networks. I don't know.
And all the delivery numbers are coming out today and the next few days, and it I guess highlights the fact that cars are just too expensive. I'm hanging on to mine.
What are you driving these days?
I'm driving a Subaru Crosstrek.
And this is the one that goes, how many miles a day do you put on it?
It's 2 years old. It has well over 100,000 miles on it. So I'm doing like 60,000 miles a year on this car.
Insane. Carmen, what else you got for us? And you got to explain to me this Humana story. I do not get it.
Oh my goodness. Well, yeah. So Humana's had a big jump today, a big fall today. It's down about 20% right now. The insurer disclosed a drop in Medicare Advantage quality ratings, and this would have a very drastic impact on revenue. So basically, it said the proportion of its membership enrolled in 4-star plans and above for 2025 is down to 25%. From 94% in the prior year.
Okay, I don't understand how that can happen to a big public company like Humana. That's what I don't get. We'll get a healthcare geek on here, an analyst. We've got plenty of the Bloomberg Intelligence. Maybe can explain it to us.
Yeah, I agree with you. It's a huge drop. It's obviously really impacting the shares. Investors are worried that this is going to really hit revenue. And the company also said that it believed that there may be errors in the calculations. This is calculated by the Centers for Medicare and Medicaid Services. So they've appealed the results. It's definitely something we'll be following because of the really big impact on the stock here. The other one that I'm looking at this morning is Nike. I think this has been in the news a lot with the change of the CEO. Shares are down about 8% right now. The company withdrew its full-year sales guidance when it reported earnings yesterday, basically saying that it's going to give its new CEO, some time. He starts later this month. It also said that they postponed their investor day, which had been scheduled for November. That was also to give Elliott Hills a little bit more time. The company also reported just sales that fell short in the first quarter and said that it expects revenue to slip in the second quarter before hopefully improving later in the year. So
this is a kitchen sink day. I think they just said, let's throw everything out there.
Why not?
And you can put it in the context of, well, we got a new CEO. We're just kind of getting our strategy together. We'll get back to you at a later date.
It looks like the folks who sell Nike sneakers, Dick's and Foot Locker, are also lower as a result of that.
All right, very good. Carmen Reineke, thank you so much. We appreciate that. I'm a Nike person. I don't know about you, John, but I go Nike. Although
I still have my Chuck Connors.
Yeah.
From high school.
Chuck Taylors.
Chuck Taylor's.
Yep,
permit.
sure, absolutely.
Oh no, I have the Chuck Connors too. A very special, very special brand.
For the riflemen.
That were made just for me. Remember the rifleman?
The kids in the back are going nuts. Exactly right. All right, let's switch our attention back to the geopolitics, the story of the last 48, 72 hours, what's happening in the Middle East. Aaron David Miller joins us. He's a senior fellow at the Carnegie Endowment for International Peace, joining us from Washington, D.C. via Zoom. Aaron, thanks so much for taking the time here. Again, it's front and center here for not just geopolitics, but also for financial markets, and that's why we here at Bloomberg are paying close attention to what's happening in the Middle East here. We had the Iranian attack yesterday. I'd love for you to put that attack into context of what is happening in the Middle East overall. What's next for Israel?
Yeah, thanks for having me. You've got 3 wars of attrition going on. One between Israel and Hamas, Israel and Hezbollah, and Israel and Iran, which is the premier event here. And over the last several weeks, as a consequence of Israeli actions in Hezbollah, the balance of power in these 3 wars of attrition has fundamentally been altered. Hezbollah is a mere shadow of itself. Israelis estimate they've eliminated half of its high trajectory weapons inventory. And those weapons were designed by Iran in order to provide a contingency in the event Israel or the U.S. attacked Iranian nuclear sites. Well, that's more or less degraded. So the Iranians needed to find a way to respond, both to the Israeli assassination of Ismail Haniyeh on July 31, the leader of Hamas. Israelis didn't claim responsibility for that yet. And, of course, the most recent hit on Hassan Nasrallah, the head of Hezbollah. So they looked for a response that did more than what they did in mid-April. You recall when they launched 300 high-trajectory weapons of Israel, most didn't even impact Israeli airspace. But not to trigger a major Israeli escalation. I don't think they found the sweet spot. 180 cruise missiles, even though Iron Dome, David Sling, Arrow intercepted a lot of them. U.S. Navy, 2 destroyers, took down 12. The Jordanians participated. Too many got through. And there were 2 Israelis were lightly wounded, and ironically, a Palestinian man from Gaza who was in Jericho was killed. But even though there were no casualties of a consequential nature other than the unfortunate death of the Palestinian man, the Israelis now have to respond at least portraying their thinking, to avoid creating a new normal, a second time the Iranians have struck Israeli territory. And they're going to respond. Biden's going to talk to Netanyahu today before the Rosh Hashanah holiday. But I think the Israeli responses are going to be heavy. Multiple targets, oil export facilities, Iranian Revolutionary Guard Corps command and control, conventional military sites. The nuclear piece, fascinating.
Yep.
I'm sure the argument's being made that now is the time, for any number of reasons, I'm thinking, though, coordinating with the Americans, I don't think the Israelis are going to go after the enrichment facilities very deep underground, but we'll see.
Well, you mentioned that, yeah, the enrichment facilities under mountains, in fact. Is that even targetable at this point with with airstrikes?
Right. Well, you need bunker busters. You need shock and awe, which only the U.S. military can actually deliver. You need a degree of saturation and redundancy, despite Israel's skill and operational capacity. The Israelis don't have. Nonetheless, I mean, I still wouldn't rule it out as part of the target set. And then the question is, of course, how and in what fashion will the Iranians respond? I mean, without much imagination, you could envision a hop, skip, and a jump to something the Middle East has never experienced before, which is a multi-front war,
right.
Not with the deployment of thousands of ground forces, but UAVs, AI, cyber, cruise missiles, ballistic missiles, one-way attack drones. With Iran, if it said badly enough going after Saudi oil producing facilities, which they did, as you recall, in 2019. So we're closer. I'm still not convinced we're going to get there. Iran's weak, and it understands the asymmetry of power which it faces.
So, Aaron, I'd love for you to kind of give us maybe your assessment of where Prime Minister Netanyahu is in terms of his thinking these days. I guess we started this war almost a year ago with the attacks on Israel, and I guess at that point, Netanyahu said, hey, our goal is to incapacitate Hamas and get our hostages back. That scope seems to have broadened dramatically now to include, maybe some war aims in Lebanon, to deal with Iran more broadly. Where is he now?
Oh, look, I think, never write this guy off. I mean, it was unimaginable that a prime minister who presided over the single bloodiest days for Jews since the liberation of the Nazi death camps, the worst intelligence failure in the history of the state of Israel, on trial for bribery, fraud, and breach of trust in a Jerusalem district court now 4 years running, would have gotten himself into a situation where his credibility and even some of the numbers in the latest Israeli polls have gone up. Not surprisingly, because of the last several weeks and what I think we're on the cusp of with respect to an Israeli strike against Iran. So he still does, if elections were held today, he still doesn't have enough seats to put together a coalition. But there's no effective opposition. And the fact is the Knesset's out of recess until the end of October. Benjamin Netanyahu will make an assessment on November 5 who the next president of the United States is, and he'll adjust his tactics accordingly. I don't see new elections in Israel at the earliest, and the government could go to term 2026. I don't see new elections in Israel until sometime in 2025.
What's the response from the rest of the Mideast, Saudi Arabia, et cetera?
Well, there's the public and the private response, right? I mean, nobody is going to miss, other than Hezbollah, certainly among the Sunnis in the region, no one's going to miss Hassan Nasrallah. Certainly the Saudis won't. And Sunnis in Syria that have prosecuted a terrible war against Sunni populations isn't going to miss Nasrallah either. So. And that goes, by the way, also for Yahya Sinwar, the preeminent Palestinian leader who's hiding in a bunker somewhere meters below ground, probably surrounded by hostages below Rafah on Yunus. I think the Arab states really understand what they didn't in the wake of October 7th, when Israeli military capacity seemed to be not just diluted, but somehow defeated. The last several weeks, the operational effectiveness, the tactical ingenuity of the Israelis has restored, I think, their street cred. When it comes to the Arab world. That's particularly true for the Bahrainis, the Saudis, and the Emiratis, who all have above ground and below ground security and intelligence relationships with Israel. But again, it's the Middle East. Nobody ever lost money betting against the peace and stability. And I think that you have to still be pretty sober here. Yes, can what the Israelis have done be translated somehow into political arrangements?
Yep.
Lead to greater prosperity and stability? That's the core question, and it's one of the many questions I just don't have the answer to.
All right, Aaron, thank you so much for joining us. We really appreciate getting some of your time to share in your expertise. Aaron David Miller, he's a senior fellow at the Carnegie Endowment for International Peace, has decades of experience in that part of the world. We appreciate getting some of his time. And the world is waiting for the response from Israel. And presumably that will happen at some point relatively soon. The markets here, again, we had a little bit of a sell-off yesterday, nothing extreme. A little softness here this morning. Again, nothing extreme. S&P off only 6 or 7 points here. The Dow off 20 points and the NASDAQ off about 20 points. So
I would argue that there was a time then you would have seen a bigger response with crude oil. It is higher, but 3% higher for Brent, 75.82.
Yeah, I mean, and the trend had been down for oil, so we're getting a little bit of lift here off the geopolitical risk, as John points out, and so we'll have to see how this trades out. WTI crude oil up $2. We're at $72.18. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with the data. Companies adding more jobs than expected last month. This is from the private payrolls company ADP of Roseland, New Jersey. At odds with other indicators that show a cooling labor market, the big report for traders is across Friday's employment report for the Bureau of Labor Statistics. Treasuries unwinding yesterday's gains in price, and the major stock averages, they are lower right now. You have 9 of the 11 major industry groups in the S&P 500 down. One of the only groups that was higher, energy, as crude oil moves up on the geopolitical tensions. Consumer discretionary, worst performing industry group right now in the S&P 500. Of course, that's home to Tesla. After their delivery numbers, they were pretty good, but investors wanted more. Shares of Tesla right now down 5.5%. Then you have Humana shares sinking for the biggest one-day drop in about 15 years. Right now, Humana shares actually pairing some of the earlier losses. They are down about 15%. Overall, S&P 500, 10 points lower. That's down 0.2%, 56.98 on the index. The Dow Jones Industrial Average is 71 points lower. That's down about 0.2%. The Nasdaq 100 right now, 19 points lower. That is down 0.1%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul.
All right, John Tucker, thank you so much. We appreciate that. Looking at the markets here, I mean, again, you could say, given the geopolitical tensions, maybe this market's behaving fairly well, over the past couple of days. As John was just mentioning, we do have a little bit of a sell-off here, off just about 0.2% on the S&P 500. But the question is kind of, how do you thinking a little bit more long-term as you try to think about the geopolitics, maybe even the strike of the dock workers and the economic impact that could have? How does that impact intermediate to longer-term views? Let's check in with somebody who does this stuff for a living. Marianne Bartels, Chief Investment Strategist for Sanctuary Wealth. And Marianne, with a name like Sanctuary Wealth, I'm thinking you guys think long-term, maybe relatively low levels of risk. What's your investment view of markets these days?
Oh, I can't get more bullish. And I understand that there's a lot of geopolitical risks. We have a port strike. We have an unprecedented presidential election. But what I've learned in my 40 years is that liquidity trumps everything. And the Federal Reserve is on an aggressive path, in my view, of now easing monetary policy at a time when our economy is growing. We're growing at least about 2%. I would argue we're still at full employment, and we still have corporate profits growth. We're not even in a recession for corporate profits. That this is going to ignite our economy, maintain employment, and I'm pretty bullish. Now, that's not to say that the markets can't be a little tricky or spooky in the month of October. But what the month of October has that most people don't talk about is we make important market bottoms that allow the market to have its strong year-end rally.
Where do you think the best opportunities are now? I mean, we've had some rotation in this marketplace. It's no longer the big tech stocks that are leading us higher. We've had some rotation in some other sectors. How are you positioned?
So that's really a bullish thing, that we have the breadth of the market expanding. So when we recently had new record highs in the market, breadth hit a new high. We got volume expanding. That tells us we're in a very strong market or a very strong tape. I haven't given up on tech. I think tech is in a consolidation. It's had an extraordinary move, but it's allowed other pockets of the markets to move. Can you believe that utilities could rally 20% this year? As the market is expecting rates to come down, they're seeking out yield within the equity market. You've seen moves in REITs. And it might be possible next year that the phrase or word TINA comes back. There is no other alternative as the market continues to seek out yield as the baby boomers move into retirement.
So, I mean, we've seen some volatility. I mean, we have the VIX now, just still below 20, but it feels like there's been some volatility in these markets when you talk to a lot of pros out there. How do you deal with that? Are there sectors that maybe protect you from that, or are there other ways to look at maybe getting a little bit of stability in a portfolio?
So, I mean, the true way to get stability in a portfolio, if you really want to be very defensive, is to own cash. And the market's already positioned there. We have $6.4 trillion in money market funds. Many clients have tried to lock in that 5.5%. I would argue that the market is extremely defensive. But, pockets of utilities tend to be very defensive also within the marketplace. Another bright spot is we have gold that's recently been hitting record all-time highs. So, you can put a little bit of gold in the portfolio because I do think over time we are more in an inflationary environment. Although we're seeing inflation come down now, and I think into next year, I think we already have the ingredients for inflation to come back.
All right, we're speaking with Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Thankfully, Alex Steele has made it back from her sojourn out to Calgary. She's back in our studio here.
I mean, you say that now, but wait until what comes out of my mouth in the next hour and a half.
Very good.
So anyway, I just got back, literally just got into the studio. Marianne, I noticed obviously that you were talking about being bullish and being positive and liquidity, et cetera. How does China factor into this? Because you're already feeling bullish about liquidity, regardless of what China is actually doing. Could that be a catalyst?
Yeah, yes, it can. And it's not just China. We have central banks around the world that are cutting interest rates. It is very possible as we move into next year that we get monetary stimulus that we haven't seen since COVID in 2008 and 2009. And that's what I've learned throughout the years. Even though some bad things can be happening around you, the most important thing to the market is, can companies grow their corporate profits? Markets trade on profits, not on potentials of potential risk. Now, what would change my view? Because we do have a lot of risks out there. If crude oil spiked very sharply and especially got to 100 and stayed over 100, I would view that to be extremely negative. I mean, my bullishness would turn pretty much to bearishness. But, as you mentioned, China, I think what China is doing seems very unprecedented. I'm not an expert on China, but the one thing I've learned is when central banks allow you to buy the stock market, you should buy, buy, buy. We saw Japan do that near its lows. In fact, the central bank actually outright bought its market. So when a central bank is allowing buying of the market, I think you should own it. I think part of the reason you've seen such a sharp move up in China is so many traders were short the market.
Right.
So we've had this major short covering, but most fund managers that manage money either globally or in emerging markets are underweight. We have a lot of room to actually move money into China.
All right, Marianne, thank you so much for joining us. Always appreciate getting your thoughts there, remaining clearly bullish there. Marianne Bartels, Chief Investment Strategist for Sanctuary Wealth. One of the names that's under pressure here today, off about 5-6%, is Tesla. The company's first quarter sales gains this year, they come up short. The vehicle deliveries, they did rise 6.4%, which is good, but they were trailing analyst estimates here. So again, the stock selling off a little bit. Let's get the latest with Keith Naughton. He's a Bloomberg's auto reporter. Keith, what are you hearing out there about Tesla and their earnings here?
Yeah, there's a little disappointment on the vehicle sales. They came in just under analysts' expectations, about 1,000 vehicles under. They sold 462,000, and 463 was the consensus. But more to the point, they kind of missed the whisper expectation, which was maybe as high as 470. Seems like there's some softness in the Cybertruck. There also were high expectations for sort of a cash for clunkers sort of promotion going on in China. They've doubled the incentive for EV sales if you turn in an older model there. That was expected to give more tailwind to Tesla, and that didn't quite materialize the way that investors expected, so the stock is down.
Just in terms of Ubers, for example, every Uber I'm in now feels like it's a Tesla. I don't know if you guys experience the same thing. And I feel like, is that a good or bad sign for Tesla? Because, okay, it's promotional, but I feel like the reason why all the Ubers are now Teslas is because it's a promotion like, get this off my lot. Are we at the trough with that?
Yeah, Model 3 and Model Y, that is the volume of the company, which are their, mainstream cars. Their luxury Model S does not sell very well anymore. It's getting pretty long in the tooth. And Cybertruck, is priced sort of around 100,000, and that limits its volume under 20,000 probably for the quarter. So They are becoming a more mainstream brand, and when that happens, they become Ubers.
So, Matt from Westchester emails in here and says, is Tesla ever going to have a new model? We haven't had a new model like ever, really, like just an upgraded model.
Yeah, this is, sort of a long-standing issue that the product lineup, with the exception of Cybertruck, which for now is a niche vehicle, that the lineup is getting stale. But, Elon Musk is really focusing more on Tesla as an AI company. They have this event coming up next week to unveil the robotaxi that he's really been talking up. And that's actually moved up the stock from the way he's positioning the company. So he's trying to speak less like a traditional automaker and more like an AI tech company.
I feel like it's always been that. It's been like, Tesla's a tech company. Nope, it's a car company. Nope, now it's an AI company. How does the sales, though, that we're seeing for EVs, because that's still the bread and butter, how is that stacking up against its peers like a GM or Ford?
Well, I mean, Tesla still far and away leads the market. But GM, for example, had an excellent quarter in EV sales because they've just rolled out this $35,000 Chevy Equinox electric vehicle, and that's a great price, and it's below Tesla's lowest prices. So new competitors are coming in. Tesla's supposed to have a lower priced EV coming next year, but Elon hasn't really talked much about that. So, as more competitors come in, as they come in at the lower end of the market, that's going to chip away at Tesla's share.
All right, Keith, thanks so much. We appreciate that, as always. Keith Naughton, auto reporter for Bloomberg News. Tesla reporting numbers a little bit light relative to expectations. Stock trading off about 5% here today. What is one to do in Calgary in October?
Well, one just really takes a cab to a hotel, sleeps, gets up, and then goes to a conference, and then goes to the airport. But I hear it's a lot of fun, and there's stuff to do.
This conference was what?
It was called Energy Disruptors, and it's basically an event that talks about energy disruption from AI to old forms of energy to new forms of energy. But it was a really cool crowd. I mean, there were like high school kids there, all the way up to traditional like CEOs. I interviewed the CFO of Suncor, and it's the first time they were invited to the summit, and the idea that like the old traditional players are going to have to do the new cool things because they're the one that makes the money. So we talked a lot about that. And then I learned a lot about the regulatory system in Canada, which feels a lot cooler than it is here. I talked to the head of the regulatory agency. I also talked to the CEO and president of GE Vernova Canada and sort of the innovations that they're doing there, and hydro being a big bet. It was really cool.
Yep, and I mean, I'm learning from you and from others. Energy's really big in Canada, like with timber and all that.
Did you bring us anything?
Yeah, did you bring us anything?
I brought you me, and barely, so no.
Oh, great.
There we go.
We're very happy.
Good luck with
We'll
that.
just power on again. All right, we're going to have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News. With this Bloomberg Business Flash, the major averages have right now turned mixed to very little change. The S&P 500 unchanged, 5709 on the index. Dow Jones Industrial Average, right now that is higher, up 23 points at 42,178. The NASDAQ Composite Index is 10 points higher right now. Let's start with the worst performing stock in the S&P 500. Humana shares down over 15% right now. Humana down, in fact, 16.1%. The insurer suffering a drop in Medicare Advantage quality ratings. Consumer discretionary, that is the worst performing industry group in the S&P 500, and that is home to Tesla. Those shares down 5%. Third quarter deliveries not as great as some had wanted. And then you had the data, U.S. companies adding more jobs than expected last month, and this is at odds with other indicators that show a cooling labor market. That was from ADP this morning. The big report, Friday's employment report from the Bureau of Labor Statistics. Treasuries also unwinding some of the previous day's gains. And as I mentioned, this major stock average is mixed to very little change right now. NYMEX crude up 2.4%. Brent, the international benchmark, that's up 2.2%, 75.15 a barrel. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. Alex Steele here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. So last night, Democratic Governor Tim Walz and Republican Senator J.D. Vance sparred during the CBS News vice presidential debate in New York that featured fireworks over abortion rights, the economy, and foreign policy, in part in an appeal to Midwestern voters.
One thing that Joe Biden did is he continued some of the Trump tariffs that protected American manufacturing jobs. It's the one issue where Kamala Harris has run away from Joe Biden's record.
Well, Kamala Harris's day one was Donald Trump's failure on COVID that led to the collapse of our economy.
If Kamala Harris has such great plans for how to address middle-class problems, then she ought to do them now.
How is it fair that you're paying your taxes every year and Donald Trump hasn't paid any federal tax in the last 15 years?
Well, joining us now is Henrietta Treyes, Managing Partner and Director of Economic Policy at Veda Partners. Henrietta, did we learn anything last night?
Well, we learned that maybe both parties' candidates have the potential to improve their standing with the American voter. The surprise to me was that flash polls that came out right after the debate showed that viewers considered the two men effectively tied in the race. I thought personally that Vance had exceeded Walz, but that's not what we saw in the flash polls. And most importantly, amongst unaffiliated voters, not Democrats, not Republicans, but sort of third-party voters, the majority of them thought that Walz did a better job. And you have to think of that as probably some of the last moments of the campaign, sort of the debate, the last sort of 15 minutes when they talked about January 6th again. But in general, net, both candidates' standing improved materially with voters. I want to say that J.D. Vance went from a negative 22%, a negative 13% rating to a negative 2% rating. And Tim Walz also improved from his +3 favorability rating to something like +34 after last night's debate. So both men did what they wanted to do, introduce themselves to the American public, and the American public liked what they saw.
Henrietta, can you give us a sense? I'm trying to get a handle on this particular number. How many independent voters are each candidate trying to get at, each campaign trying to? I mean, do we have a sense of how many they are?
Well, the independent voter base is actually a huge chunk of the pie. As America has gotten polarized and voters have, flocked to the far left or the far right within their parties, a big chunk of America now qualifies themselves as independent voters. That's different than undecided. Undecided is now like 4%, 7% of the electorate. Most people have picked a horse and they're moving forward. Unfortunately, most likely the people who are undecided did not even watch last night's debate. So they're going to be getting their internals from what they see on the internet today. And it's probably not going to move the needle too much. If you have to think about the presidential debate not moving the needle a whole lot, a couple points to Kamala Harris, it's very unlikely to me that the vice presidential debate last night is going to really change things for either ticket.
So it's October 2nd, if I'm not mistaken, and typically we talk about an October surprise when it comes to the election. Is the Iran-Israel conflict right now that October surprise?
You know, I want to say yes. Obviously, the escalation that we're looking at right now and potential for the Middle East disruption is explosive to the point where we haven't seen it in decades. And, you know, rapidly escalating and just waiting for Israel's response now. But the question last night was the first one out of the gate about how to respond to Iran. And I think what was interesting is that the electorate as a whole in America doesn't consider this a near-term issue or even something that ranks in the top 5 areas that they care about. It's, you know, the economy followed by some combination of abortion and immigration, and then everything else sort of way underneath that. Foreign policy is just not a forte of American voters.
Henrietta, Kamala Harris has been out fundraising former President Trump. And in past election cycles, that would be really big news. Is that big news this time around?
I think it is, and I want to tie in a couple different components here. You know, we have Hurricane Helene that went straight through Trump country in the Panhandle of Florida, Georgia, and North Carolina, with the exception of Asheville and like a couple of blue pockets. But the turnout campaign, not just on the day of the election, but right now as early voting has started, is something that all this fundraising is able to actually do. Kamala Harris's campaign has, you know, a dozen field offices in certain states that are going to be pivotal to this election, where Trump has almost none. There are campaign volunteers that are getting paid $20 an hour to go out into the field and make sure that they're knocking on doors and getting people to the polls, getting their mail-in ballots sent. That's the kind of money that's being spent right now. And you're seeing it trickle down into the state races, which are now expanding the Democratic map into places they have no business being, you know, Texas, Florida, Nebraska, and then also on the House side with an expansion of the race sort of exponentially in the last couple of weeks. And that's because of the massive fundraising campaign that the Harris campaign has generated. I think it's, if my memory serves, it's $287 million in August to Trump's $84 million. So they're tripling their numbers.
$20 an hour for volunteer. That's pretty solid. Like that's
then
something.
That doesn't make them a volunteer, does it?
It is true. That feels odd, but you know, maybe it's for-profit volunteering. Henrietta, when we take a look at the broader race in terms of Congress, Senate, and the House, where do we stand? What are some races that you're watching?
Well, I mean, my favorite part of this election is that we have the benefit of every single swing state also having a Senate race happening. I want to lay out 2 that I think are really important today, and maybe the VP debate can move the needle. In Arizona and Nevada, you see Kamala Harris's strength coming from the fact that she's pulling 13 to 15% of the Republican voter base. So in Arizona, 15% of voters that identify as Republicans are saying, you know what, not today, not for Trump, not for Carrie Lake, who is the Republican Senate candidate there. They're going for Galeo and they're going for Kamala Harris. And that's why she is even playing ball in a state like Arizona that used to be deep red. And that's translating just next door to Nevada, where you're seeing strength for Kamala Harris amongst Republican voters. And that's translating down ballot to Jackie Rosen in that Senate seat, who's ahead by 10 in the latest polls on average, if I'm not mistaken, something like that. So the Senate candidates down ballot for the Democratic Party are pulling so far ahead of Kamala Harris, so far ahead of their Republican challengers, and not all of them are incumbents. You know, whether that's in Michigan or other states, there are Democratic Senate races being held in all these pivotal states that Kamala Harris must win. And I think it portends either a massive split election or additional votes that Kamala Harris can get in the final days of the campaign.
All right, Henrietta, thanks so much. We really appreciate it. Henrietta Trez, Managing Partner and Director of Economic Policy at Veda Partners, joining us there. You early voted already, didn't you?
I did. I just mailed it in yesterday, early and often. I'm a big believer in that. And I'm also happy that I'm not in a swing state. John, we're not in a swing state, are we, in New Jersey?
Well, don't say your vote doesn't. Every single vote counts. Let's emphasize
That's why I dropped it early and
often.
often.
Even though we're in New Jersey.
So, but in New Jersey, we're not a swing state, so we're not getting crushed by the political ads yet. But even the national buys are noticeable, you know. But I mean, when you get in a swing state, every local buy is, you know, on every station. You can't get away from it.
I can't imagine. I mean, I've always lived in New York, so I literally can't imagine. All right, coming up, we're going to talk about Nike is trying to just wipe the slate clean here for the new CEO. Has it done enough there? Like, what is the trough for this company? Poonam Goyal, Senior U.S. E-commerce and Retail Analyst for Bloomberg Intelligence, will be joining us as we take a look at a market that is going pretty much nowhere fast on this Wednesday.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so check us out there. Nike, stock down 6.5%. They reported some numbers. I guess the street's not digging it here. I'm a Nike person. I don't know about you people, but I am a Nike person. Not huge brand loyalty, but I mean, why not? They're big. They're everywhere. They got all kinds of stuff. Poonam Goyal joins us, senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. She joins us. Poonam, this looks like what I would call back in the day when I was doing this stuff, a throw it in the kitchen sink kind of quarter, where they just kind of did everything to kind of get it out there. Tell us about what happened with Nike in the last 12 hours.
Sure. So Nike, reported sales that fell about 10%, and it was in line with expectations, but it was weak, right? Their sales continue to drop, and there's no signs of a recovery, at least yet, until they have a better plan in place. I'd say this year for them, their fiscal year is going to be the year of a reset. Once the new CEO comes into play in just a few weeks, he will have a new playbook, and that playbook will drive Nike's turnaround in the fiscal 2026.
So part of that was, yes, cleaning the slate for him. They got rid of their investor day for all of those reasons. Can we assume that this is the trough? This is the worst it's going to get. It's only up from here?
I would say fiscal 2025 would be the year of a trough. I wouldn't necessarily say that fiscal 1Q is a trough, because as you probably heard, they have guided to fiscal 2Q sales to be down 8 to 10%, which is roughly still in line with 1Q, and with the holiday season being unpredictable, We have port strikes. We have a shorter holiday season with fewer days of shopping. Things are still very much up in the air from a macro perspective, and then Nike has its own troubles on top of that.
All right, so from your perspective, Poonam, what is the problem with Nike?
The problem is that they don't have enough newness in their pipeline, and they haven't been focused on merchandise. Nike has to have good merchandise, new merchandise, performance-based merchandise in front of consumers on a constant basis to really drive the outperformance that they had seen pre-pandemic. They lost that under the current leadership because the focus was more on DTC and using the franchises that did well and really just adding new variations of them. For example, the Air Force, right? We have so many variations of the Air Force. Same with the Dunks and same with the Jordans, just new color waves. So we need to see more. We need to see them do more on the product front and then the marketing of it, of course, too.
Is the stock trading as if we know that full year 2025 fiscal year will be the trough, or is it trading in a different way?
I think we should mostly know that this year is going to be the trough with a reset, because I for sure have confidence in the new CEO's ability to turn this thing around, because he does come with a long tenure with the company. He knows what the product needs to do to get back onto consumers' feet. So we have confidence in the new CEO. We are waiting, just like everyone else, to see what plan he puts forward to really drive this turnaround. But it won't be until fiscal 2026.
So what's Nike saying just about the consumer in general these days? Because I would think, boy, with their broad product line and reach, they would have a pretty good view.
The consumer is uneven. They're spending in certain places and then they're not spending. For example, they talked a lot about their new product that they brought to market earlier this year. That's actually done really well for them. And that's a good sign. But then the rest of the stuff is just status quo. They are seeing weakness in their own retail channels, and the weakness is coming from traffic, right? So this goes back to the macro a little, where traffic is down in the stores, traffic is down online, and traffic is what's hurting sales because the average selling price was actually up, which means they're able to sell these expensive sneakers. They're just not able to get enough people to come in and buy them.
Okay, do Nikes have sneakers with those heels? Because if they did, I'd feel like we'd be in a... Yeah, there's like a whole brand of like sneakers with a heel.
No.
So they're like stilettos and then they have the look of a sneaker.
Oh, boy.
I don't think they have that. I think that would be helpful.
I don't think they have that, but I don't know if they actually need that to win. They probably...
Well, then they're not talking to me.
I need running too.
Fair enough. But in all seriousness, though, how is China doing for Nike?
China is not doing well. China has struggled for some time. And I think the China struggle will ebb and flow. The highlight for China is the new stimulus that they have just gotten. And I think that can serve as a catalyst to help at least improve sales from where they are today in the near future, because that should get Nike back onto people's feet there as they have more spending power. The thing is, though, everyone's fighting for share in China, right? That's the growth engine for most athleisure companies. And while Nike does have a lead still in China, it's one among many players, the locals and the nationals.
30 seconds, Poonam. What's the the holiday season look like? Do we have any growth there for U.S. retailers?
There will be growth. We think e-commerce is going to lead, but we think there's a value play here. Consumers are stretched. It's a shorter season. There's going to be a lot of deals in the next few weeks with Prime Day kicking off. So shoppers will shop deals and will shop early.
Right.
Yes.
Nice.
She said the word.
Speaking of Alex
deals.
I'd say I bought a lot of the holiday stuff over in Ireland. We just got a big package delivered yesterday for all our stuff. Yeah. So last year was the year of the alpaca wool, because we have an alpaca farm near us.
Okay.
Has a lot of cool stuff. This is just all things Ireland.
Wait, you have an alpaca farm near you in the Jersey Shore?
Yes, we do. Very cool. Come on down and see it.
Is that a thing that happens?
They have literally award-winning like alpacas there. Yeah, and they make all kinds of cool stuff there. In Wall Township, John.
The alpacas are winning awards?
Yes, from Wall Township, New Jersey, for like alpaca wool and stuff.
Wool and fur stuff.
And they don't spit at you as long as you're nice. They spit at each other. They don't spit at you. So
the things you learn. The things you learn. All right, coming up on Bloomberg Intelligence in the next hour, Carol Schleif will be joining us, Chief Investment Officer at BMO Family Office, what her outlook for the market is. We keep hearing about growing liquidity, where to put the cash.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. We have a great lineup for you. We're going to kick it off with Carol Schleif, Chief Investment Officer at BMO Family Office. Then Ellen Wald, President of Transversal Consulting and Senior Fellow Atlantic Council, will be joining us on the conflict in the Middle East and its effect on oil. Plus, Stephen Flynn, Bloomberg Intelligence Senior Credit Analyst, will be joining us on DirecTV and what it needs in order to buy Dish in terms of bondholder agreement. And Jen Bartashis, one of the best Bloomberg Intelligence Senior Analysts for retail staples and packaged food, on the port strike and how and when and if it will drive up food prices for us over here on the East Coast. Well, let's kick it all off for you right now with a business flash with Charlie Pellet.
All right, hi, thank you very much, Alex Steele. We have got the Dow higher, the S&P, NASDAQ. They are both lower. Bottom line here, stocks churning, as Alex said earlier, a whole lot of nothing with the S&P down 3 right now, 57.05 where we stand, a drop now of just under 0.1%. We got the Dow up 11, a gain there of just under 0.1%. NASDAQ unchanged on the day right now. 10-year yield 3.79%. The 2-year is yielding 3.63%. Gold retreating from yesterday's advance, down $15 the ounce to $26.47, while West Texas Intermediate crude up 1.7%, 71.01 a barrel on WTI. Stocks are struggling to stem losses. Treasuries unwound the previous day's gains following stronger than expected jobs numbers. Again, the S&P little change. Nike shares, though, they're down almost 6%. After last night's earnings call, Nike is facing one of its roughest patches in decades as it moves to reset Wall Street's expectations ahead of the new CEO, Elliott Hill's arrival. Poonam Goyal is with Bloomberg Intelligence. She was a guest moments ago right here on Bloomberg Intelligence.
The problem is that they don't have enough newness in their pipeline and they haven't been focused on merchandise. Nike has to have good merchandise, new merchandise, performance-based merchandise in front of consumers on a constant basis to really drive the outperformance that they had seen pre-pandemic. They lost that under the current leadership because the focus was more on DTC.
DTC direct-to-consumer, Poonam Goyal with Bloomberg Intelligence. Again, we've got Nike down by 5.6%. Recapping stocks trading mix, the Dow, NASDAQ, they're both higher. S&P will call that unchanged. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. Appreciate that. So I guess what the catalyst is now, Paul, when you have equities kind of going nowhere at this moment.
Jobs. We'll get that on Friday. Yep. And a lot of the whisper numbers coming in a little bit weaker than 150,000 consensus here. So people just trying to get a sense of is this economy landing softly or maybe not?
And what that winds up meaning then for the equity market, and then how do you position? All right, well, let's get some more individual names to focus on. Nora Melinda joins us here. Humana's getting hit pretty hard. I was trying to understand what the story was here. Can you walk us through it?
See, I actually had to stop and talk to our health stocks reporter because it's really complicated.
It is, right?
Here.
Okay,
it's
good.
very complicated, but she gave me a great breakdown. That's Angel Adebasan. So this is the biggest decliner in the S&P 500, and that is because Humana, which is an insurer, essentially Medicare is usually government funded and government organized, but they also have Medicare Advantage, and that's specifically by private insurers. It's sponsored by the government still, but it's private insurers who actually manage it. And so essentially Humana is falling for its worst day in 15 years after its quality ratings dropped. And so that is by the government. They actually decide these ratings for private insurers. And essentially, because of this rating drop, they will see a drastic threat to their revenue. And this is not the news that investors want to hear, especially as they're thinking about the insurers that they're interested in pouring money into.
What I don't understand is why the rating drop. How can it go from 94% to 20 or whatever it was? I don't get that. Glenn Losev, he's the Bloomberg Intelligence analyst who covers this. That's going to be the first question. And if he can't explain it to me, then we got a problem.
Then we really have a problem.
I've read everything that's out there. I still don't get it.
Right.
So.
I mean, it's such a complicated industry, but I mean, we are seeing such a brutal drop today. We're seeing shares down as much as 24% in trading.
And also, like, what's a quality rating? Like, what does that even mean? Anyway,
Right. All this
these
lingo.
are all good questions. Conagra, you're also looking at that company.
I'm also keeping an eye on Conagra, and this is actually a manufacturer for packaged foods. And I'm watching this stock. It's down. It's the second biggest decliner right now in the S&P 500. And this is after it actually experienced an execution disappointment.
The spirit of "we'll figure it out" is my favorite thing to hear among early startup team members. A lot of things go wrong. The situations that startups win in tend to be incredibly dynamic. And so this idea that even if I'm not qualified on paper, even if I haven't solved this problem before, even if this problem feels like it's going to kill the company, which many problems will feel that way, this spirit among the team of, you know what, we've got the people we need, we're going to figure this out, we're going to get this done, that's super important. Another thing that I love to hear from early team members is, I've got it. So, you know, you hear in big companies a lot, people say, that's not my department, someone else is going to do that. Or, you know, ooh, this is really bad, this is going to hurt us. And you want people who just step up and say, I'll do it, I've got it, don't worry about it. You want people that have a bias towards action. Startups, especially in their early days, often win by moving very quickly. You never get as much data as you'd like. You never have as much time to deliberate as you'd like. And you want people who are willing to act with much less data than they like to have, with much less certainty. And then if they act and it doesn't work, they adapt really quickly and try something else. We talk also about the blessing of inexperience. We have seen many of our startups do incredible things because no one told them it was hard, or no one told them they can't do it. There's a great quote from Steve Wozniak about how all the best things he ever did came from having no experience whatsoever and having no money. And, you know, that obviously is not always true, but there is a magic thing that happens with startups, especially in their early days, before they've learned they're not supposed to be able to do certain things. And so I think as a startup, again, it doesn't work to have everybody be inexperienced, but you can take more bets than you normally would on inexperienced but super high potential people. That's the end of the topic on team. One of the most important jobs you have as a founder is to never lose momentum. And this is a little bit depressing because it means for the first few years, you never get to take your foot off the gas. You never get to really rest. We try to be honest about this, that startups are not the best choice for work-life balance at all, but especially in the early days. Startups survive on their own momentum. If you have momentum, people keep delivering results beyond what they think they're capable of. If you lose momentum, it's very difficult to get it back. And so continuing to make sure that the startup has a cadence, that the startup keeps winning on a relatively short and predictable intervals, this is really important, and it's up to the founders to make sure that you don't lose a hold of this. Another thing that we think startups need is a competitive advantage over time. Now, this is something that sounds so obvious, I hesitated to even put it in. This is well discussed, but we're seeing more and more startups apply to YC, and when we ask them, so what is the long-term monopoly effect here? What is the long-term competitive advantage? What is, where is the network effect in this business? They look at us like it's the first time they've ever heard this question. All of the really great businesses I know have an answer to this question. And in fact, the better they are, the more they pretend not to. But this is something that you want to have a plan for. Another thing you want to have a plan for is at least a sensible business model. You don't have to have it all figured out at the beginning. But when we ask founders, so how are you ever going to make money? And they look at us like it's the first time they've ever been asked that question, which happens more often than you would think recently. That's a bad sign too.
When you look at the last few quarterly reports, especially the big months of quarterly reports, markets have actually done well because the fundamentals have come through and our companies have proven very resilient. So having portfolios, reminding investors that we've got some fixed income in there for stability, we've got some growth bias in there because the underlying trends are very positive, has been a great place to be.
Well, it also goes to the other point of how many bullish catalysts there are out there right now. And I'll break it down. Okay, we got margins could actually be better than expected as interest rates wind up coming down. You also have, as you pointed out, earnings, and expectations have been revised lower, so the bar is pretty low. The Fed is cutting 25 or 50 in November, but they are cutting. Stimulus from China, definitely fiscal spend from the U.S. government, no matter who wins the White House. I'm struck, like, what is the downside? Like, how do you not buy equities in this market? Plus, excess liquidity is really high.
Well, and I think that's why a lot of times it's called the wall of worry, because the market keeps grudgingly hitting new highs, but you're not seeing the traditional exuberance or ebullience that would mark a market top. And so from that perspective, there is a substantial amount underneath. And actually, you can make an argument that a lot of business activities actually been held in reserve because everyone for the last 2 years has been fearing a recession around every corner, and interest rates were high. Now you've got a reversal of those. We've got a lot of people saying, well, geez, maybe we averted the recession. And oh, by the way, the GDP revisions that we just had erased that technical recession that everyone freaked out about a year or two ago, because that's not even in the numbers anymore. And it goes again to how resilient these companies have been.
Carol, how about the fixed income space? Where do you see opportunities there in, again, a interest rate environment where presumably this Fed's going to continue to lower rates?
Yeah, we're preferring clients not wait around in cash. Cash has been very comfortable for a lot of people, that they at least go a bit out on the curve and lock in some of these yields that you're getting now. We're not ready to go out towards the 10-year or longer, because we actually think the 10-year yields are lower than they'll end up being, because we do believe there's an underlying growth bias. You referenced a lot of the fiscal spend that's out there. There's a lot of stuff that's been targeted, and there's thumbtacks in it, but based on some of the numbers we're seeing, less than 20% of what's been allocated is actually out there. And one of the interesting things is you've got a lot of bonding bills on state and local ballots this fall, and to the extent those get passed, you've got a lot of spending teeing up that's matched by those federal funds. And so you've got the opportunity to really put some extra growth underneath a lot of these things. And so we think as that gets absorbed, that you'll see that the 10-year yields drift higher, not lower.
So, Paul, you'll be so proud of me. I did email my guy, and I was like, hey, so I have this money in my high-yield savings. Should I put it in munis? I'm just saying, talking about where the money should go. I thought of Paul. He likes the munis. But it does raise the question of, in the equity side, where do you wind up rotating that cash? If the scenario that we all talked about in terms of the positive catalyst play out, do you rotate into the cyclicals? Do you stick with tech? Do you barbell it?
I think you barbell it, and I also think you move down the capitalization curve, because there's a lot of argument that a lot of those small caps have been very fitful at their participation. They'll participate for a week or two or a day or two, and then they'll pull it all back. And on those pullbacks, it's nice to be able to round up some of those, because they have, by and large, they're going to have better access. They're going to have more floating rate debt. They're going to benefit more disproportionately, if you will, from the Fed bringing rates down. And they're also going to participate as the economic activity stays robust in the United States.
Ellen, I want to get your thoughts on alternative investments. How do you put them in the context of the BMO family office in terms of asset allocation for your clients, whether it's private equity, private debt, hedge funds, that kind of thing?
Yep, private equity, private debt. We're probably less. We have selective spots where we use hedge funds as much, probably not as much as we might have a decade or two ago, but a lot of private capital in general. We also have other things. We are very active in doing some custom structured notes for our clients. We look at a lot of interesting non-correlated asset classes, catastrophe bonds, some of the interesting niches in credit. The nice thing we have in terms of the private capital that we go after is we can go to smaller funds rather than the multi-billion-dollar and super big funds. Our sweet spot is some smaller funds that get a lot of less attention, if you will, and are in some very niche stuff. So our clients like it a lot.
We were just talking about Nike with Poonam Goyal, our Bloomberg intelligence analyst, which leads me to the consumer, right? How do you play a K-shaped economy at the end of the day?
It is difficult, and it's interesting because one of the pieces that I'm preparing to write is you do have this. There's a lot of angst out there that is coming through in consumer confidence numbers and also coming through in polling numbers. But you've got the odd part is the top 20% of the populace produces 40% of the GDP activity. The bottom 20% produces 9%. So that top 20% is really going to drive the overall macro number. But interestingly enough, that bottom 20% has a chance to drive what happens at the ballot box in 5 weeks. And to the extent that they turn out and vote, you have a chance to shape policy intermediate and longer term. And so we do a lot of talking like that because obviously our clients are going to sit at that top portion and they're going to be in a very different scenario. But their kids, their grandkids, are looking at a lot different environment because they're finding it difficult to find daycare, difficult to find houses. They're over indebted in a lot of cases with college debt, things like that. So it really is difficult. And we have a lot of those conversations one by one.
All right, Carol, thank you so much for joining us. Carol Schleif, she's a Chief Investment Officer for BMO Family Office, joining us there via the Zoom thing here. Some red headlines crossing the terminal. This is going to be good. But some real moves here from the creditor side for this Dish DirecTV deal. You recall Dish and DirecTV, the two satellite companies have a deal to merge. However, they got to get the bondholders and creditors to kind of agree. Now, it looks like they're going to have some problems there. Dish DirecTV deal sparks creditor revolt over $1.6 billion loss. The key group of Dish creditors to use stake to block a debt deal. Now we're going to have Steve Flynn. He covers the high yield, the tech media telecom from the high yield perspective. So he's the absolute perfect guy to talk about that. And he's going to be coming up later in this hour.
I mean, if you want anything at all, like that's a sure bet versus if your bond's trading at what, anywhere between 50 and 65 cents on the dollar, at least 60 is a sure bet. I don't know.
Yep. And here the thing is just from the equity side, which I covered both of these companies from the equity side for decades, is the business is going to zero.
Right.
So I mean, if you're a bondholder, it's not a question, do you want this deal to go through? It's just a question, how much am I going to get paid?
At what price?
So this is a negotiating tactic here, and just going to try to negotiate, a better deal here. But this, at the end of the day, if you remember, the other part of this news of this deal, DirecTV and Dish merging, but then TPG Group, the private equity fund, is going to buy the 70% of DirecTV that it doesn't already own. So in effect, these two companies, DirecTV and Dish, will be owned by a private equity company.
Exactly.
Yeah.
So this shifting landscape.
Yeah, and this private equity company, they've got some sway out there. But let's see, there's these Dish bondholders, and there's a lot of them because there's, I think, close to $9 billion of debt at Dish.
So we will talk about that with Stephen Flynn in just a moment, Bloomberg Intelligence Senior Credit Analyst, plus Ellen Wald, who's president of Transversal Consulting and Senior Fellow at Atlantic Council. Wall Street Journal just breaking this headline that OPEC Plus agrees to ease production cuts in December. I'm going to say ... It just depends on what Iraq and Kazakhstan are doing in terms of its production output and if they're adhering to those output cuts.
There's a lot of research on this. There's really been three. Number one, prosperity, as you've said. Number two, improvements in healthcare. So in 1900, half the children died on the planet before their fifth. And the third was the education of women. So we've had some pretty interesting questions put up here, but let's try this one. What keeps you up at night and what gives you joy?
Well, I think kids give me joy. So I probably get the most joy from my kids. You know, I'm not saying that that's the reason to have kids, because we should have them anyway, but I certainly, kids are the greatest source of joy in my life. In terms of what keeps me up at night, I guess it's anything that's like, I think, a civilizational risk. You know, if we're, you know, birth rates continuing to plummet, I do think about the birth rates plummeting as being a civilizational risk. I think anything that undermines the foundations of democracy in America or elsewhere as a risk. I think anything that's leading us away from a merit-based system is a risk. I actually spend I listen to like podcasts about the fall of civilizations to go to sleep. So perhaps that might be part of the problem here. There's luckily a podcast called Fall of Civilizations, which I've listened to a few times. I'd also recommend Hardcore History if you haven't listened to that. It's a great podcast. I listen to history podcasts basically to go to sleep. So that's probably why I'm ruminating on these things as I go to sleep.
It's all day long here at Bloomberg. Turnaround since our last update for the U.S. stock market, with the Dow, the S&P, NASDAQ all in the green. The S&P 500 index right now, best level of the morning, up 857.16, a gain of 0.1%. We've got the Dow up 57 now, up 0.1%. NASDAQ up 59, higher by 0.3%. And the Russell 2000 index of small cap shares, little changed, up just under 0.1%. 10-year 3.79% with a 2-year 3.63%. Stocks struggling to find solid footing as treasuries unwound the previous day's gains, and gold is down $17 the ounce, retreating now by 0.7%, $26.45 the ounce, while West Texas Intermediate crude oil just above $70 a barrel. WTI up by about 0.8%. We got more on oil coming up in just a moment. Tesla posted its first increase in quarterly vehicle sales this year, though the automaker let down investors, expecting more of a bump from China boosting electric car subsidies. Tesla shares today, they are lower now by 3.8%. And Stellantis' U.S. sales plunged 20% last quarter, the fifth consecutive decline. Stellantis, of course, the parent of Jeep and Chrysler. Stellantis shares down now by 0.1%. Recapping, S&P higher up by 3, a gain of just about 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thanks so much, Charlie Pellet. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from our Interactive Broker studio right here in Midtown Manhattan. As Charlie was just talking about, WTI is up by about 0.7%. We're trading at 70.34. The latest headline that just crossed from the Wall Street Journal is that apparently key members of an alliance made of OPEC Plus agreed to ease curbs in December. This is at an online gathering that took place on Wednesday, and according to delegates in the cartel, basically OPEC Plus has taken oil off the market, and they need to find a time to put it back onto the market, whether it's going to be a slow drip, whether it's going to be a full stop, or whether they're going to have to cut again in order to support the oil price. All of that surrounding the oil market right now. Ellen Wald is president of Transversal Consulting and senior fellow at Atlantic Council, and she joins us now. What is your read through on that headline?
Yeah, I think that this headline, it comes after a couple of interesting headlines from Saudi Arabia saying, they're worried about oil going down maybe to 50, or they're not pursuing $100 oil anymore. I think that this is really reflective of a process that OPEC has been going through over the past quarter, maybe even half a year at this point, where they're looking at the market. They know they've got to start unwinding these cuts that they've had in place for a long time, but they're really conscious of where the market is going, what demand looks like in China, and what they have to do to kind of ease the market into accepting that, yes, they are going to be putting more oil on the market. They've already delayed the return of this oil. It was supposed to start coming back on the market in October, and they're really just, they're pushing it, back to December, but they're saying, yes, we still plan on doing this. I do think, as you mentioned before about Iraq and Kazakhstan and some overproduction going on there, it's entirely possible that they will be excluded from this increase in oil output, because the way that it works is each member only increases a certain percentage. So each individual member is only going to be putting on really a very minimal amount of barrels. They may exclude those members that had been overproducing from this in order to prevent, too much oil from flooding the market.
Hey, Ellen, Javier Blas, who is a Bloomberg opinion columnist covering the energy space, he's out with a note today saying that the oil price that matters now is $50, not that $100 fabled $100 barrel target. That's not relevant anymore. Maybe the new target's 50. What do you think about that?
That's an interesting conception. I do think that there is definitely we've kind of switched from, how high is it going to go to how can we prevent, there from being kind of a bottom. I do think that he's saying this in part because the Saudis have definitely been hinting at the prospects of, they have the potential and the ability to flood the market with oil and push prices down. And that's really the only leverage that they have to get other OPEC members and other OPEC Plus members in line and to keep them in line and adhering to their quotas. And so the Saudis say, look, you're not adhering. We can flood the market. We can open the floodgates and we can, increase our production up so high that prices will go down maybe to 50 and maybe even lower, as we've seen in the past. And that will have a major impact on the ability of these other countries to bring in revenue. But for the Saudis, it's really not that big a deal. They can take it, whereas those countries will really significantly be hurt. And so I don't think that this is a threat that they're making idly, but I don't think it's around the corner. I think you'd have to have some pretty severe actions, to see the Saudis go through with this.
Yeah, and then to that point, their break even for oil prices is super low, but their fiscal break even is like 85. So they can just pare back spending domestically if they needed to support that. The last time they flooded the market, it was to hurt shale producers, and I find it interesting that this time, if they wind up sort of rolling back those cuts, it's to force compliance among its own members. It's just an interesting twist. Before we let you go, how much geopolitical risk premium is in the oil price right now, and how much do you think should be in the oil price right now?
So that's a great question. I do think there is some geopolitical risk premium. We've seen prices reacting to events, maybe 2%, 3% is geopolitical risk premium. I think it's hard to kind of divvy that up between the Middle East, between Russia. I think that any kind of risk premium that's associated with the idea that Iran might say close the Strait of Hormuz is really not well founded, because this is not the same environment that we saw in the 90s or the 80s or even the early 2000s. Iran is not going to close the Strait of Hormuz. It's not even clear they can physically do that, but doing so would so anger China. And China is now the main customer of, it's Iran's main customer, it's Saudi Arabia's main customer, it's the main customer of all of the Middle East oil producers. And that would so anger China that the consequences would be such that they would be devastating. So I don't see any reason why Iran would do that. I do think that there is an elevated risk in the Red Sea, and that's really where analysts should be keeping an eye on in terms of the potential for some serious disruption.
All right, Ellen, thank you so much for joining us. Ellen Wald, she is a president at Transversal Consulting and a senior fellow at the Atlantic Council, and she is one of our go-to voices on all things global oil. And we're seeing oil pare back some of the day's gains that had been up close to 2.5%, 3% on WTI and Brent crude, and they're now both up only about 0.5% here. So I'll keep an eye on global energy market. Another thing we're keeping an eye on is the deal market in the satellite business. Just last week, we had Dish Network and DirecTV, or just a couple of days ago, Dish Network and DirecTV announced a merger, putting the two cable networks together. But this is contingent upon the Dish creditors kind of okaying a deal deal and a restructured debt deal. And it looks like we're seeing some news here today that creditors, this is in Bloomberg reporting, creditors to U.S. satellite television firm Dish Network plan to block a distressed exchange. That's a key part of the tie-up with rival DirecTV, and that's according to people familiar with the matter. To get some detail on that, we bring in Steve Flynn. He covers all the high-yield world in that TMT space. Steve, what's going on there with Dish and their creditors here? Because they do have an ability to kind of block this merger, don't they?
Yes, this is a very complicated transaction. So if we take a step back, there's a lot of things going on here with EchoStar. They announced a series of transactions on Monday, including the merging of their satellite pay TV business, Dish DBS, with DirecTV. Now, Dish is highly leveraged. Dish needs to reduce its debt, and the DBS business